It's a pleasure to host you, Andrew, who would be joining in online. But soon after that, we will have a presentation on data analytics. It's an opportunity for us to go through a methodological session where we equip ourselves with the opportunities in technology that we can actually tap for the banking sector, and not only for the banking sector, actually the financial sector at large. So these two presentations are somehow intertwined and so closely related, no wonder they are placed together. So the second presentation would be done by Dr. John Olukuru and Mr. Joseph Theuri Kitonga of Strathmore University. So I want to welcome Andrew Njeru to take us through the first presentation, then we'll listen in to the second one before we do a discussion on the two subject areas. So you're welcome, Andrew. You can hear me?
Yes, I can hear you. Thank you, Dr. You can hear me?
Okay, you can progress.
Okay, thank you for that introduction. So I'll be taking you through this idea. The subject, of course, is asset quality assessment in the absence of quality data towards optimal credit intermediation.
Just a minute, Andrew. Can you put the slides on slideshow, the full screen, so that we're able to. Okay, thank you. Proceed.
Is it? Hope you're okay now. Yes. So.
Yes, we are okay. Is it possible for you to hide the presenter view? There are 3 dots right below your screen, below your slides. Huh?
Okay.
Hide
presenter view. Okay, thanks.
Okay, we are now not able. Yes, should be well now. Okay, you're welcome to proceed.
I'm trying to move forward. Okay, so basically, you're aware of this pandemic. It has posed a very significant challenge to credit officers and risk management functions in the financial institutions, and not just here locally. Things are moving very rapidly back and forth, and it becomes very difficult to actually exactly know what's happening to the portfolio. Some customers, you may be able to see some partial view. You have bankings, but given that most customers are multi-banked these days, they bank across many platforms, you always don't have a full view of how they are behaving. So the whole idea here is to use alternative data to predict and actually assess how the customers, the business of the customer is behaving. the data can be obtained from various sources. Part of it is alternative data from publicly available data on the internet through web scraping. Yes, and just to re-emphasize what I'm saying, it's very important for the lenders to continuously being able to review the performance of the portfolio for many reasons, ICAP process, risk management process, and also to be able to make sound decisions at the time a customer is asking for money. I think one of the challenges I think I just mentioned earlier, most borrowers are giving us, they tend to provide the financial statements late since COVID happened for many reasons, and you've seen even publicly listed entities are also not able to deliver their financial statements in time. And of course, this is impairing the ability of credit managers to assess credit. The issues like social distancing measures are reducing the ability of bankers to feel the ground, to know exactly what's happening. So the whole idea then is to use alternative approaches to obtain the data. Yes, so what do you propose? So you propose a model to use alternative data sources to track the traffic on customers' online and offline platforms. We use the data provided both by the customer and also publicly available data, including foot traffic from parking meters, where places like malls, traffic to the malls has direct correlation to the kind of business level and volumes that a customer is having. Then we do have the web traffic data. Google is very, very famous and people are always searching for stuff. So for businesses, you can actually easily tell whether there is enough traffic on a particular business. It can be holistic it can be specific to a customer, or it can also be specific to an area like a mall. There is other data, including data from their own websites, Google Analytics. For customers with websites, there's a lot of very rich data that you can actually get from Google Analytics in terms of how active online customers are, how active customers are online searching for services. That is a very good indicator of how the business is, because most of the traffic can actually move from foot traffic to online traffic. And then we complement all this data. And of importance to note there is customers can actually give you much data that they probably don't even use, which you can then use. Yes. The next level is to use this data to observe the quantum of changes and compare that data with the historic trends. We have to undertake some seasonal adjustments to factor in the business cycle. Obviously, we know, like for schools, there's a cycle. It's when you expect our parents to be searching to be looking for purchasing for materials related to schools. Other places like some other seasons that are obviously high for everything. This is the December season and holiday seasons. And then we combine this data now and overlay on the customer's known past history of performance on the balance sheet, in their profit and loss statements, and then see the impact of the top line on the bottom line. So we'll see when the traffic changes, the turnover, the sales will drop, and that will affect. So it will affect the profitability. We also factor in that some costs are fixed. Things like salaries are fixed. Yes, and this has to be also, then you go to the next stage, of course. So you have to factor the effect of the traffic changes, of course, after all the adjusting for the seasonality, then include discussions with the clients to assess any exceptional items. The clients do have exceptional items such as known costs that have already been incurred. For example, of costs in this COVID, we've noted a lot of customers and they're taking mass layoffs. So those are extremely huge costs. They have a major immediate hit, but they also reduce, they improve the viability of a customer going forward. Like they're more likely to survive when they have reduced those fixed costs, especially like salaries and the rest. Then you have to create a projected period that profit and loss and a balance sheet. Because we have to combine even the existing data, account activity data, and trends from the bank's cash flows. From this, then the last step is to basically simulate using the internal models. And I think most banks now do have models that they're using, whether it's for scoring or ratings. And then you're able to plug up the red ones, customers who are more likely to experience default and default distress. And then there's a whitelist that customers who have really benefited from the pandemic. So those are the ones you want to prioritize. So again, we don't assume that everyone is doing badly. So you can actually see a particular segment of pockets, even within a sector that's doing very badly. Some pockets will actually do pretty well. Yes. Then once you simulate using the existing models, this doesn't have to be very complicated. You can use publicly available models like the Z-score for bankruptcy prediction. You could use that, and then for a bank that has a rating model, you could actually use this data and see what current rating should be using the simulated profit and loss and balance sheets numbers. And then that can help you to arrive at the final ratings that the banks always calculate. So that's, you're not suggesting any change there, but you could actually even adopt additional methodologies to even assess the performance of that business, whether it's okay or it's deteriorating, improving, deteriorating, or probably simply the same. We presented a similar model, a model last year that could be used. It's not data intensive, uses very few data points, and you can actually end up in a PD, an indication of whether the customer is doing better or worse. So advantages, the data is very forward-looking and real-time. It avoids exposures to, helps you to avoid exposures to counterparties with deteriorating quality. You can use the data to reduce ECL. This is expected credit losses from the IFRS requirements, and having obtained this data in this is actually allowed under the IFRS 9. So the data is quite objective, and so other advantages, you can use the data for any existing models, internal rating models, scoring models. You can even overlay it on other models. I can just talked about that. It also gives the credit managers some comfort when making decisions in tablet times, like to see that how things are working now. And yes, I'm just showing here a sample balance sheet. As you can see on column 2016, the traffic will drive what turnover would be after observing the trends. And then once you establish how it's affecting the trend, and that is after combining on and offline traffic and offline, then you're able to see the impact of the turnover. I think now there's quite a bit of data that you can actually get up to now. And then each line has an impact on the rest. Some things like a direct cost of sales, of course, the correlation is direct with the turnover, because if you're not selling, then there will be no cost of sales. Of course, that will have a hit on the profit and loss, certain gross profit. And distribution expenses, of course, they tend to vary to move with the cost of sales, but some components of distribution, such as staff costs, may a bit be fixed, and then others are variable. Then you have so basically you are able to move down from turnover and then simulate downwards to get your projected bottom line. And so probably then open the floor. Questions. Yeah, can someone hear me? Yes.
Andrew, sorry, we lost you a bit. When you got into this slide, I think you can pick it up again from the beginning.
From here?
No, after this.
After this?
Yeah, yes.
Okay, so I was just explaining, and you can hear me clearly, because I've seen someone say like I'm not clear.
Yes, now we can hear you clearly.
Yes, so I was saying one of the advantages is that the data is very forward-looking and it's real time. Then you're able to give credit managers some comfort when they assessing credit, that they are dealing with the facts on the ground. So nothing, so the impact on the customer's operations is clearly visible from the available data because it's real time. Well, it's almost near real time. Yes, the data can be used to run your existing models in a bank, your internal ratings models, your scoring models, and you can even use additional approaches which you're also proposing. We've discussed that in a previous forum under KBA research platform. Then you can actually use that and then you're able to end up with a probability of default for a customer based on very accurate and real-time data. Then the data can also be used to help you calculate the expected credit loss at customer level and also for the entire portfolio, which you can then use to reduce your expected credit loss for where clearly things are much better than you might actually see. Yeah, so that is one of those are the benefits that we do have. And then you're able to even whitelist some customers who you may think that you're probably doing badly off, but you're able to actually see things are not as bad as you may think. Yes. So I was explaining this slide also that once you establish the impact of the customer's traffic on the business traffic on the turnover, then you'll be able to actually simulate the entire balance sheet of the customer and the profit and loss. But of course, what is most important here is the P&L, and then which will also drive how the projected balance sheet will behave. Those are simple. I think quite a number of institutions do have models platforms to even project the future. So once you're able to establish the impact of turnover and the key drivers, which will be the customer traffic, which costs are fixed, and then feed in the additional data from the customer, especially on exceptional items such as layoff costs, and you'll be able to establish an interim kind of a profit and loss statement, which you then can use for your models. So that is the whole point. Back to you, Sam.
Yes, you are muted. I don't know whether you had progressed with some discussion.
Yes, you can progress.
Yes, okay.
So I hope I was clear.
Okay, are you done with your presentation?
I'm done, yes. Yes, I'm done.
Okay. Thank you, Andrew, for painting a picture of what currently happens within our credit asset quality assessment, particularly with the challenges on the data and the fact that there is a need, the fact that there is a gap that can actually be filled through the alternative data sources that we can explore. So in the course of your discussion, I think I picked up a few things that maybe just you to clarify even before we open up the discussion to the rest of the plenary, is that you talked about data, the approaches being very data intensive, and the fact that it's also forward-looking in a way. So of course, where there is data intensive, it means then the approaches should be robust enough to really be able to capture all the data and some level of accuracy at the same time. Then issues around verification of this data in terms of the accuracy before we adopt them for decision making in such a sense. Then with regard to forwarding, of course, you have an aspect of expectations. You have an aspect of predictions that is embedded in it. So to what degree would you be comfortable with the accuracy of the information and of course the predictive power of some of the metrics that you use? Then the second aspect is what's the future of the current approaches that we are using, and particularly shedding more light on the current practices and the impact of COVID-19. Of course, are the current practices still valid? To what degree? Is it that time that we thrust into a new space when we are looking at alternative approaches? With this, to what degree can we rely on what we have traditionally known as the approaches that we use for asset quality assessment? Then in terms of course, you have painted a very interesting picture. I was just wondering whether there are any limitations or any policy challenges that you encounter in the process of exploring these alternative data sources. Of course, the internal policy or even any conflicts with external policy, like the prudential regulations or even IFRS 9 requirements. What are some of the challenges? Even that would be of benefit to some of our participants, actually practitioners in the banking sector.
Thank you for your comments. One of the things I would say is that the data is quite robust and we're using multiple sources. The methodology you'd use to collect the data is actually an automated way. We do not recommend physical manual collecting of the data. The setup of the web scraping tools is pretty standard. You can have, we do have, the platform, the technology has really improved currently, and it's very possible to get someone just to do it for you, and then you just need to describe to give the location of the businesses that you're targeting. Then automatically that is scheduled, and it can actually be offloaded into cloud. Of course, you have to factor in the data privacy issues, so don't use free cloud space. So make sure you use, working from banking sector, I think it's always good to use technologies that are not going to give you a lot of headache when getting approvals. Ideally, you want to use one cloud. One is called OneDrive, and one from Microsoft. OneDrive, yes. So you can automate that, and the data is quite robust. For the larger businesses, it's extremely accurate. For the smaller, the lower you go on the hierarchy, then it becomes less accurate, but especially for the small things like shops. But again, if the shop is within a mall, then you can actually easily tell that any business is in a particular area, because banks tend to have such concentrations, especially when you have financed a large facility. So you have concentrations. Yeah. Then secondly, in terms of accuracy, it's quite accurate because you don't want to have a manual process. Thirdly, even in terms of accuracy, you will also complement with customers' own data, which is also pretty accurate. Customers with websites, quite a number of them do have now, and even social media platforms, you can see the level of engagement on business related engagements, and you can actually see how active you can actually gauge the level of activity, and this can be done using the professional tools that are available, widely available. Google Analytics is a platform offered by Google to help you assess the traffic on your websites, and it's heavily used by airlines, but I think even other smaller businesses are beginning to see the utility of that. And of course, can use customers' own data, not just the what you could scrape off the web. Customers also have their own data, which is things like I mentioned things through the parking traffic. You notice what happens when there's a lockdown, or which they just want to go out. It affects the parking traffic, especially in places that are enclosed, whether it's malls or even generally across locality. That data can be available. I think you just need to focus on exactly which areas you want to focus on. So in terms of accuracy, it's okay. Limitations, a few limitations, especially if you may not be able to get access to some data, that can be a limitation, but the middle to large businesses, you'll find most of the data, and those are the exposures that are really of concern to you, and they constitute probably almost 60% of your portfolio. Policy challenges. In terms of policy, there is nothing in policy that tells you not to know how your customer is performing. Yes, it's actually encouraging in all the policies, whether it's prudential guidelines and even internal policies, credit quality assessment, credit monitoring, and administration. You encourage to get as much information as you can, and then once you get it, that's when then you want to see whether it has any correlation with the business performance, and then that's how then you come up with your own model. Yeah. IFRS, no major issue. I think IFRS is quite open also, because IFRS opens, it gives you, it leaves room for judgmental estimates on performance based on both judgment and also any data that you can get. And actually this helps you to reduce the subjectivity of the estimates that you're feeding into the IFRS process. So that with this kind of data, robust data, then you're able to give data that is auditable for auditors as an input into the ACL, expected credit loss calculations for IFRS. Policy challenges from the central bank, I think the only bit would be that issue of data privacy. So as you do the web scraping, make sure you don't store your data in a free website. Yeah, and even if you have to store it in free websites, make sure it's not identifiable with, for example, a business registration number or a national ID number. It should just be, you code it in a way that it's not usable by anyone who may stumble on it. Thank you. Over to you, Sam.
Okay, there's a question from one of our online participants, Caspar Lidiema, saying that in the absence of data when web scraping, when would web scraping be ideal? Most of the SMEs are noted not to have online data, and neither do they publish their financial statements online. So how can we web scrap? How can web scrapping help in the scenario assessment of asset quality, particularly to SMEs?
Yes. For SMEs, well, I think SME definition is also depends on one organization to another. Like from where I work, there are quite a number of SMEs with very robust platforms for where you can actually get a lot of data from them. But where you don't have enough data from the normal websites, the social media platforms are also pretty good. You can use to do web scraping on, because even the smaller SMEs, you find that they also tend to be quite engaging on the platforms, on the social media platforms, whether it's Facebook, Instagram, or Twitter. And the ones who don't have, then you keep narrowing down your your gap, the data gap. So having a, let's say you have a portfolio of, for a typical bank, let's say a mid-sized bank, you realize almost 40% of your SMEs, you can actually get some data from them about them. And another component probably I think I probably did not emphasize enough is your M-Pesa traffic data, M-Pesa transactions data. That is very, very important and a rich source of data. You can actually pick, that's what we are proposing in terms of you can actually use the M-Pesa statement and easily do analytics on it using a methodology that I presented earlier last year or 2 years ago. Because cash is king in banking. So you can actually tell the traffic, how the cash flows and the behavior, should I call it the business activity is on the M-Pesa statement. But I think right now, literally every small business that like the ones Casper is referring to, they are all M-Pesa, literally all of them. So you see a lot of rich data from that, and you can actually see the trends over time. And it can help you a lot to establish the cash, I mean the trends, and then people to be able to project and see the behavior. The cash is king. As I said, cash is king. M-Pesa statement alone or a bank statement alone is huge indicator. In fact, if you look at the credit policies within a bank, the behavior of the account is like, it constitutes almost 80% of what you can tell about a customer. Sometimes you can miss it when the customer diverts cash flows, but the ubiquity of M-Pesa can actually fill that gap that Casper has alluded to. Thanks.
Okay, thank you. Now I think at this point I will invite comments, any questions from the plenary here. Okay, there's a question from a colleague from the banking sector.
Yeah, thank you very much. My name is Roy, and thank you, Andrew, for the provoking presentation.
Maybe just to confirm, Andrew, you can hear Roy?
I can hear, yes, clearly.
Okay, thanks.
Okay, so I think, Andrew, that's very interesting and thought-provoking. But my question is, how scalable is this web scraping and using Google Analytics, considering some of the operators in our economy really go through or operate through the informal economy? I like what you've said around using M-Pesa data, but my question to you then is, would you rather consider open banking where all banks can share data to a platform? Because if they're not transacting with my bank, they're with your bank. If they're not with me, they're probably with M-Pesa. So will open banking, and what are the possibilities of us evolving as an industry into an open banking scenario, also where we share with telcos data, and it will be very easy, especially for the smaller banks who don't have scale, to leverage off the bigger banks, since the bigger banks have a lot of data. Again, M-Pesa, the number of subscribers is huge number. If we can leverage off the spending patterns on the M-Pesa platforms and the card customers, then it becomes very easy to credit score, and you can have various credit scores of M-Pesa, of say KCB where you work, of other banks, and then you can overlay with your own interpretations or risk weighting for each of those scores, and then you can have a blended score which you can use. So is open banking worth considering to achieve more scale compared to web scraping?
Yes, thanks, Roy. That's a very good idea. First of all, as I mentioned, for the middle and upper larger size businesses, which also tend to be your highest concentration of risk, you'll be able to do a lot of this web scraping. But some of them you can actually use social media profiles, pages that they have. M-Pesa, I think I've mentioned, it's a huge complement to the data you can use. Open banking, extremely good idea, but sometimes you don't have to wait until the regulator is able to support that initiative, because that would be dealing with 42 banks, and each has their own strategy how to approach the business. So it might take you a longer time than probably trying to use what is currently available can help you to move very, very far. And you don't even need to have an open banking to use M-Pesa data from the customer. Currently, you can get, the customer can give you the M-Pesa statement in a secure way that you can use it to do your analytics and then come up with a proper assessment of credit quality. And it's an evolution, whether it's improving or getting worse. Yes, so thanks. But suddenly, open banking is probably the best solution for any mid-sized bank or smaller to be able to get more opportunities to lend. Over to you.
Thank you. Thank you for the feedback. Any other comment? Maybe a final comment before we progress to the next part in a very related field and speaking to each other. Okay, so thank you very much, Andrew, for enlightening us on this subject matter of a space that is remaining strongly unfamiliar and strongly unexplored for many, particularly in sourcing of data, critical data for decision making in terms of asset quality assessment. So at this point, I would want to invite the next presentation, which is actually providing also some insights on the same subject matter of credit assessment and in a broader sense, of course, looking at the opportunities within artificial intelligence that could actually be adopted for banking or by banks in Kenya. So at this point, I would want to invite Dr. John Olukuru and Mr. Joseph Theuri from Strathmore University to take us through the next session.
It's okay. Oh, so I have to. No, it's okay. It's fine. Okay. Yes, it all looks great. It's okay. Fine. That's okay. Yeah. Okay. Good morning, everyone. I hope everyone is well, and all those following us online also are able to hear me and to follow our conversation here. Thank you very much, Njeru, for starting up a wonderful discussion on data in banking. I think our presentation will be around this, could say an idea, tapping into potential in banking. So I'll be presenting with Joseph Theuri Tonga, who is a data scientist at Strathmore University. At the end of the entire presentation, my wish and hope is that our banking sector in the region can look at shaping customer experience with digital behavior analytics. That is my overall expectation, that we can share ideas, share insights, such that our region can now transform and see how can customers, all of us, one or another interact with banks, can we realize that our experience can be changed? because this already is what's happening in developed countries. So for the rest of the people, I think following online, just feel free to share any insights, question in the chat. I think Hosea will help me to address them. So I'll start with a few slides just to put things in perspective, and then Joseph will come across just to demo a simulation we've done. So of course, with the era of data, you realize we can't really put out clients' data in a conference like this. So we had just to think of what have we done for other clients and then simulate something for a bank we are calling Feather Bank. So that will come towards the end. So to just set the tone of the presentation, I have this clip. I hope sound will be clear. Let me just try to play it fast, then we see if we can follow a few concepts there. It was done in 2016. So you might imagine somebody's projecting what was supposed to be done in 2020. So already a few things are already happening.
If there are billions of conversations happening every minute, imagine how many times your bank must have been talked about while you finish watching this video. Each conversation is a business moment for you to create a memorable experience for your customers that they would want to share with others. Envision the world's future. From smartphone to a smarter phone. From a car with a driver to a car without a driver. Future is the next present, where our imagination today has become Lisa's fully automated banking experience in 2020. While Lisa is sleeping, her phone receives a notification regarding the shipment, which is ready with the exporter. The intelligent software checks for funds and notifies her bank that she would need a letter of credit. Understanding an urgent change in schedule, her phone automatically resets the alarm for 7 a.m. so that she can plan her day. By the time Lisa is ready to go, her smartwatch receives a notification that her black vehicle is low on fuel and suggests that she drives the red car. The GPS selects the shortest route and Lisa arrives the New Age Bank's intelligent branch sharp at 9. From the moment Lisa arrives at the bank's special branch with no staff at all, the door installed with intelligent communicator scans Lisa to notify the bank about her arrival. Bank's interactive walls talk to Lisa to tell her about how she can transact better with bank's offers or corporate credit. Meanwhile, her smartwatch directs her to a special kiosk where the bank welcomes Lisa, automatically logs her in, and connects her to an expert who is a client of the bank too, to guide her about the needs for the letter of credit. Within minutes, her letter of credit is approved, the exporter receives the payment, Lisa's shipment is released, and the time is just 9:15 a.m. Rewinding to today, can you imagine the intelligent banking experience on a vacation? While Ted is enjoying his vacation, a bike, Harley, passes by, catching his attention. The bike has been Ted's dream since school. Ted takes a picture and uploads it on his social media account. Instantly, bank's intelligent software picks up Ted's interest in this bike, analyzes his post on social media, his sentiment, his conversations about the product, and after analyzing his spending pattern, the bank offers a pre-approved bike loan along with information on the best dealers around, their discounts offered, and the color options available, all on the go. While Ted is still on vacation, bank's geotagging technology identifies Ted's location, instantly analyzes his credit card spending pattern, and offers him the best deals on bike accessories at a nearby store. And this is not all. Before the vacation ends, the bank delights Ted by offering him free airline miles and complimentary hotel stay to plan his next vacation. Imagine millions of customers like Ted for a bank like yours. The intelligent software enables you to continuously track to engage, interact, and offer a futuristic banking experience to your valuable customers. Place, time, or medium no longer matters. Engage your customers. Delight your customers. NewGen products help you do just that by connecting systems, processes, people, and things of your business. Reinvent your workplace with NewGen.
Very good.
If there are
So that's just to put the whole entire discussion in context, that banking has been reimagined. That is what somebody developed a few 5 to 10 years ago. Today it's happening. Today it's happening. And realize more than 50% of our customers today, that was by statistics in 2020, last year that is, they were saying all of us demand for personalized services. I want to be known. I want the bank to know my problem. I want the bank to know my changes, all my demands. If I have a problem, I call customer care. I need to be addressed as John, not as a group of lecturers. This is how they always behave. What can be able to solve that? Data analytics, and that is AI and machine learning models. So what I could try to say, as at the moment, we are moving from the aspect of using a sample data to big data. Developed countries are already moving to smart data. The previous presenter mentioned about lack of quality data. It goes down just to automation. Come to investment your tools and try to see how can I collect good data for all customers out there. The clip just showed you of a fellow on a holiday, and the banks be able to geotag to know where he is, what he's trying to do, and offer him something else. So the omni-channel kind of operations for bank becomes a reality. So just something to take note over here, you realize at the back office, you can use machine learning to detect fraud patterns, cybersecurity attacks, and that can be real-time transaction analysis for risk monitoring. So banks in Europe, in the US are already doing this. When it comes to the front office aspects, just that smile to pay, facial scanning. I'll just show you a clip again coming up soon, just to see it's already happening. I know all of us are using M-Pesa, and when Juguna came up with "your voice is my password," it looked like a wow. But I still remember when we went with some few of my friends from Safaricom to Singapore, and they saw this happening. That was 2016. We just had it recently. Why are we always lagging behind? Does it mean our region doesn't have talent? We do have talent. The micro-expression analysis with virtual loan officers. Yeah, sometimes people might want to talk to an individual person. But if an algorithm is done so well, such that the robot can really behave as a human being, wonderful. I'm sure you've heard of not really a joke, it's a reality. Somebody in Japan who married a robot because somebody made a robot to have feelings like a human being. So you know very well, if you're tired with a robot, you'll switch it off. But of course, you have a human being at home, you can't switch her or switch him off. They'll still be there for you. So biometrics, the voice, video, print, to authenticate a number of things that can happen in a bank are the few ideas that you can say banks are expanding to start using AI technologies to improve customer experience. Just to demo again. So this is a clip where voice was being used to make transactions in Singapore. At the end of the day, it's voice plus face recognition. Sorry, just a second.
Hey Siri, how much is my bank balance?
Here are your OCBC bank accounts.
Hey Siri, pay Donna $5.
Here's your Pay Anyone payment of $5 to Donna. Pay Anyone sent your payment.
Hey Siri, how much did I spend on my credit cards?
Here are your OCBC bank accounts. Okay, please authenticate to continue.
So that is OCBC Bank. I was just commenting to a few of my friends. You go to Singapore, you realize that the best employer is the government. So therefore, most banks that have the largest shares owned by the bank will have the higher priority to get customers in Singapore. Therefore, a private bank like OCBC from China was finding it difficult to get into Singapore. What do they do? That was one thing that came up. How can they make that transaction easy for each and every customer? Second thing, to start tapping into the students in the universities. So if you get them to join your bank while they're in the university, there's a high chance they'll still remain with you when they get jobs. What do? Change their experience. And realize OCBC is just an example of a bank that can get into a market, apply AI technology, a number of scenarios that can change customer experience. At the end of the day, you have a wonderful customer base. So the AI bank of the future, of course, you're looking into profitability. That's the rooftop of everything the banks will want to do. But above all is personalization at a scale. If possible, a very large scale for customers. That omnichannel experience, that you have the same service, but you're offering across many other platforms to different customers or even the same customers all through. The speed and innovation that things come up also becomes a big plus, because now AI becomes something to realize in real time what's happening wherever you are. So a few concepts on the reimagined engagement. Will be coming up with intelligent products, tools, experiences for customers and of course employees. I know most of the time we look at always externally, but when we try to do a number of things at Strathmore, we say charity begins at home. If that bank teller is not happy with what's happening in the bank, how sure are you they'll transfer the good experience to the customer? So the HR analytics becomes very key. So do a number of things at home, apply all these things to work before you can be able to progress out there. So within the bank channels, what journeys can you be able to come up with? So all the web applications, mobile applications, smart devices in the branches, Internet of Things. When you saw the clip, a smartwatch communicating with a kiosk, that's Internet of Things. And that goes back to the source of data that we have. Have we set up platforms to collect that smart data we are looking for? So sometimes you can have all the models, have all the tools, but our sources of data is not the correct kind of source we're supposed to have. So you have poor quality data, as the presenter mentioned in the first paper we had, and that now also leads to a challenge to the decisions you're going to make. So the digital marketing is another source of getting a number of things coming up today, which now leads to AI-powered decision making. And all that is now the second base I put there on the wall, which is advanced analytics. So the demo theory will just take us through the aspect of credit decision making. But there's a lot on customer acquisition, which goes into sales analytics, market analytics. There's a lot into monitoring and collections. There's a lot in retention and cross-selling and upselling, and even now servicing and engagement. And all this will now be your AI capabilities. So the whole entire foundation is what people talk about: the natural language processing, the voice script analysis, the virtual agent bots, the computer vision, face recognition, blockchain, robotics, and that now behavioral analytics. And at this point, I could just comment about, as at moment, our market, we are still stuck at the 4 levels of analytics. Descriptive analytics. That's why I think somebody asked in the first presentation, how do I get SMEs data if they don't even publish their financial statements? You realize our focus is on structured data, financial statements. SMEs are producing other sources of data other than just the financial statements. Can you find a way to tap into that? So the structured data is only 15 to 20% of the data is available out there. Unstructured is the key to a lot of opportunities that we are not really tackling out there. So descriptive analytics, we are doing it. Diagnostic analytics, we are trying to do. Now people are starting to implement predictive. Of course, now can get us to prescriptive. Now, many companies are looking at behavioral analytics. That's now the cognitive and adaptive. Can we get there? We need smart data. I was happy to hear about the web scraping, and you can get the geolocations of where businesses are. Now, if I'm looking at personalization, the question goes, how can I identify where John is, what he's doing at Crown Plaza, so that I can give him something from wherever he is? It goes into investing to collect that personalized data. Just one more clip, I think, just to give us a proper sense what's happening abroad.
We have as an organization a philosophy, what we're trying to do is become the #1 bank for customer service, trust and advocacy in the UK. It reflects our transition from the bank that we were before to the bank we are now, and the bank we are now is very much focused on doing the right thing and benefiting from doing the right thing rather than just trying to benefit.
It's about making the customer the center point of every decision you make. And how we use that data, how we put that together, how we visualize that data essentially becomes the lifeblood of how the business starts to make those better decisions.
We have 2 primary use cases for the data. One is about making better business decisions. The other one's about using data to help our customers. So if we take the first of those, that's the SaaS visualization tool, right? It's about how do we visualize data. Because if we think about making better business decisions, the ability to put into someone's hands their business represented in data is incredibly powerful. The visualization of data and the ability to deliver that data, that was the key driver for how we were going to execute that piece of the strategy. If we talk about the customers, the ability to work with data there is critical, as you can imagine, because we need to work with the data in the first place to understand what we see in the data, what we can infer from customers' behavior.
So it's about people being able to use data when they want, have it in a very simple form, have it in a visual form, and really be able to navigate that simply.
And I'm really excited about the journey that we're on there, because we've still got a long way to go. We've done a lot, still a long way to go, and we're going to absolutely transform our relationship with our customers by using data.
Thank you. I think the clip began, I was just trying to introduce the clip. So this is Royal Bank of Scotland. It is one of the few largest banks in Europe, in the UK. I'm proud to say I'm their customer. Yes, they tapped me a few years ago and I'm still happy with them. And the time they found me at that moment, you realize it was still a small branch bank at the university. And the branch manager knows you personally as a student from Africa. But time goes on and you realize you're no longer there with them, but they still know you. They know where you are. I remember them sending me a text message. Well done. I hope the presentation goes well. I'm like, how did you guys know? But I know because I'm online. I have a digital footprint everywhere. So the bank can understand me. So this gentleman, who calls himself the data guy, other than the data scientist, he believes the banks need to go to the bank of the 70s. When a bank was very small and the bank manager knew each customer individually. Now today, you have more than 1 million customers. How do you know each customer individually? AI is the tool. That's the scenario. That you have really you've come up with a data strategy that can push you across entire scenarios, that you can be able to tap to know your customers well. Now you find the second concept there. Many businesses always look at these tools, looks at data analytics for them to make profit. And that becomes a challenge. If you look at it the other way around, how can I use these tools to serve the customers better? To make the customer get the best from what we do for them? It changes everything. The OCBC bank clip that I just showed earlier, how did they manage to tap into students? They do not come to them saying, we want to give you a bank account or bank with us. No, they go to them as a mentor to help them understand they can be able to save to come for safari in Africa, to help them understand they can be able to save so that in future, their health is well covered. So they know of their health insurance, they know of their pensions. And with that, the thing changes. It's no longer now the bank making profit from me as a customer, but I'm looking at the bank as these guys will give me solutions. And that's where we need to change kind of the narrative. To make that customer experience better, let's look at AI as an enabler to provide that wow customer experience to the people we are looking up to there. So 4 things again that maybe I didn't want just to forget. I mentioned about data strategy. So come up with a data strategy that should also include an AI strategy. Let's move from using AI and becoming an AI company. That we have a number of employees who can really adapt and really go forward to promote the use of AI. Let's have that data culture. So data strategy, data culture. That from the beginning, that security person at the entrance, they understand they're already generating data. The experience the customer gets from there, it's a data they'll pick and they'll want to see how it can be utilized. If people understand how data can be fed into the bank, how it will get into the platform, and that at the end of the analytics will give the solution. Because somebody told me, you have data that's already been collected. By itself, it's useless. Convert that into information. Now it is something. After getting the information, the executive team are looking for the knowledge. What can they learn from the information? If the data was wrong, information will not be correct. The knowledge, the lessons found will not be the best. And therefore, the decision makers will not be seen to be wise. They will lack the wisdom that they expected to get from the data. So the third concept is, of course, the investment into the data architecture. Can you think of your data ecosystem, your data architecture? How do you manage your data? How is your data security? Now is the data privacy frameworks, how are they? Think of that. And of course, now finally, the data analytics comes into play. So of course, think of defining a use case. A use case that's going to be driven. So value-driven implementation that will use diverse AI capabilities. And with that, just one more things to conclude here. An example, a use case. So this is something I borrowed from, we invited a few CROs from Spain. That was, I think, 2017, 2018. They will come every summer. Now COVID made us not to get them. And they were just telling us this Bank Inter, yeah, don't really have to fear to mention them. I don't think they have any branch here. Bank Inter in Spain. They claim they have 0 non-performing loans. And the main customers are SMEs. And they'll tell you, when a customer goes online to apply for a loan, maximum it will take maybe 30 minutes, but otherwise in 10 minutes, they've already given out the loan because they just need to get the name, a few, and they will know where this person is going to be, and they'll give everything. So a few 3 things that AI will always have. So this is Anya, who is now 28 years old. He is a working professional. So the first place he's getting in touch with the bank is the bank app, which will recognize the spending pattern of this customer and will suggest an additional value. Hey, by the way, this coffee you can get at this Java. That's now a seamless integration with net banking application. I'll be very happy when I was told I'm coming here, all the big presentation. Of course, I smiled. I didn't care that my bank was really snitching on me. I realized they know me. The second partner is the face recognition for frictionless payment. So the customer will go and use Smile to pay to initiate payments. I don't have to struggle to go password, look at everything. Where did I go? I changed my password a few months ago. I couldn't remember. Did I have a comma, a full stop, an asterisk? My face should be enough, or just a smile, and things go on. And then there's that analytics-backed personalized offers. So the customer will get 2% on health insurance, premium based on her gym activity, and even the sleeping patterns. I think I saw this with a South African bank, where they're even monitoring, because your smartwatch is counting the steps you're making, you get rewards. And all that is linked up to a number of things that the bank is offering. So the other 3 remaining parts, just to show how the customer can really engage a number of things on AI, you get that personalized money management solutions, where the app will offer money management and saving solution. That's where I think all of us always want to be. But the first 3, we might have missed them. And then there's the second last one, how you can aggregate overview of daily activities. So as a customer, I can receive end-to-end overview of my activities with augmented reality and reminders to pay my bills. Just some ideas. You know, some people already picking some tips. Think and see, how can you incorporate AI to get search for our customer? And finally, we have that savings and investment recommendations. And that's one model of analytics of machine learning recommendation, whereby you have an integrated portfolio view and a set of actions with the potential to augment your returns. So this is a sample of how a customer in a certain bank can benefit, or a bank can use now AI to transform a retail customer. Can invert that, look at an SME, a number of things will also happen. So second, lastly, just to conclude on this, we talked about face recognition now really picking up. And I have 2 clips here. One on our right is a gentleman, you'll see him here in a moment. He did something to identify himself, so that can be done. The first one that I'll start with is a clip that shows an ATM. You'll go and withdraw your money without using your card. It's happening, not today, not yesterday, a number of years ago.
So this is our iCash device. This would be fitted. We have already dispensed more than $500 million using this exact same technology. This technology has already been deployed. There are more than 450 ATM machines already using this. no one can take them, no one can copy them, and no one can impersonate you.
Please look into the mirror. Thank you for your cooperation.
You would click a button on the screen and would look into the camera. We can be 100% sure that the money is actually going to the right person. And this makes all donors feel very, very good about their donations because it makes it very, very effective. So this is not paper vouchers. There is no stigma, whether it's a poor or a refugee or whoever it unbanked is. It offers them the service with dignity. And it will link it to the point of sale system, and it will clear the funds and do the actual payment and print the receipt, all using the iris without the need to enter any PIN or any information. And it proves that you have been in that supermarket and you've taken the items that are designated for you.
Thank you for your cooperation.
Good, that's iPay. Okay. So something just to share a little bit on a number of things that maybe our region can take up. So while in Singapore with our friends, the number of local banks here, something was very keen with banks there. They have fintech incubators, whereby they'll tap into local talent to come up with possible solutions. And that's the same thing I can just try to suggest to the region. Can we start now that AI journey? How can we revolutionize our own experience here? It's easy to go out and say, John talked about this, who is the person offering this, they're based in China, they're based in India. Very well, they'll give you a plug and play. But realize it has its own bias based on who has developed it because they are coming from a different market. Have a fintech incubator around, get local talent, let them come up with possible solutions that can just change your customer experience. And this is something that Theory tried just to create. When we're trying to come up with COVID really pushed a number of things. So today you get to a building, you have to get your thumb temperature with that thermogun. Some place they want to get your images. We're no longer signing books. I know some places people are still signing books, but now it's different way of collecting people's personal data because of course of security and the rest. So we're coming up with something to implement in Strathmore. Pass around, picks up your image, can identify your name, and everything goes into a database. So we know who is coming up. And a good example is you come to visit me in Strathmore Business School, you're still speaking there to the guard, he speaks your ID, I get a text message that Chirongo is at the reception, is coming to see you. If I didn't have an appointment, I just tell him, no, I didn't have an appointment. So you're wondering, no, I know. The guard already knows you're not supposed to be there because it was just a quick kind of a communication transaction they could say, and they already know if you're the right place or the wrong place. So something we can try back home. So just brief clip, I just cut off from what we've done just to see what can be done. Sorry. Sorry. Just something to indicate we can develop a number of those solutions locally. So we can get a few young fellows here who can be able to come up with a number of things just to combine the idea of statistics modeling, computer programming, and the banking now business domain to get things going through. So just conclude the slide presentation side of it, take away. Let's see if we can build a digital mindset as a sector, build a digital mindset, whereby now data and technology becomes the driver of what we really want to offer to our customers. Secondly, can we come up with a way to collect that huge data real time and have that a proper data lake? Let's try to see if we can map our customers across various sectors, various places. And then at the end of the day is to tap into that digital skill set. So let's not look just outside, but develop the digital skill set from within. And that could be something that we can always look forward to. So I'll invite Theory to come and just take us through. It's a simulation. So this is not actual data set. Don't look at the color and try to think, I know this color is for this and this bank. No, it's not. This is just a simulation. We came up with a bank we are calling Feather Bank, and we wanted just to demo how can you bring in a number of things all there. At a click of a button, you have a whole entire summary. Theory. As it comes, just that quotation down there, knowing what happened and why it happened are no longer adequate, but organizations need to know what's happening now, what's likely to happen next, and what action should be taken to get the optimal results. That final statement, the last one there, is our predictive analytics, prescriptive analytics, and that comes very well in hand if you have your AI solutions. Thank you.
All right, thank you very much. So what I'd like to do now is take you through a practical application of AI, particularly centered towards being able to have real-time or near real-time risk assessment of your bank, right? What we have here is Feather Bank. So in this particular example, I'll be showing you the retail side of Feather Bank, right? And how information from that side can actually be utilized to create the analytics. So on the screen, we have three modules. Yeah, we have the bank overview, the client intelligence, as well as the loan intelligence. We'll begin first with the bank overview. So the bank overview basically gives you a snapshot of the entire bank and what is happening within it. So as you can see on the screen, allow me to just move this a bit. On the screen, we have, on the left side, we have KPI statistics on the number of clients, the different savings, as well as the total loans outstanding. Underneath, you have a view of your geographical spread. So which counties have you tapped into? How many people are there? What's the distribution? So allowing you basically to monitor, for example, if you have a growth strategy on the go, allowing you to see how that is actually going in real time as the different customers are added to the database. On the left side, we have different statistics that show the different trends within the transactions happening within the bank, as well as different loans that are being issued out there. So in this case, our hypothetical bank has different loan products, and as such, you can see them on the right side. So for example, we have the Jaza investment loan. We can see statistics such as the approval rate, the number of loans, the outstanding loans, and the performance of the loans. So basically being able to monitor how the loans are doing in each category. So the idea here is basically just to bring in first the aspect of business intelligence and understanding what is happening. Yeah, this is of course driven by digitization that has been happening. A lot of banks have created data lakes. So how do you bring all this information out from the data lakes and visualize it in a simple way that is accessible to different people within the organization? And so we have a general view, and then we can break down this view by sectors and see the trends of how, for example, the portfolio has been performing across time. We can be able to see by sector how the loans are being approved, how they're actually performing, which sectors, for example, are having harder times in terms of repaying the loans compared to others, zero in on the statistics for that particular sector and get information. We also have different statistics here, for example, on the top sectors in which we are lending to. And if we move from the general overview to the client intelligence, we have a snapshot view of the client, right? So In this case, you would have things such as their gender, their age, their profession, where they are from, when they were born. You could include things such as their social media posts that they're having and incorporate it in this dashboard. So you also have things such as, for example, the account details, what credit card they have, how they've been transacting over the last end period. On the right side here, where we have the bar chart, and you can see how they've been withdrawing and crediting. And then interestingly as well, on the left bottom side, we have this in terms of the outstanding loans that the customer has. And on the right side, there's a metric there on probability of default. So how likely is this customer to default on their loan, right? And this is computed in the back end by a machine learning algorithm. In this case, it's a logistic model that takes into account the different touch points and interactions that the customer has with the bank. So from ATM withdrawals to mobile, the mobile app interactions, to withdrawals, to deposits, M-Pesa, all that information, as long as you have it, the algorithm is tapping into all these different resources and coming up with a probability of default. And this allows you to view customer information on the go for any customer that you like, as the system is running. So for example, if you had the facial recognition added onto the platform, you would have something like, I'm just trying to change the customer here. As the customer walks in, all this information can be provided on the go, where you know every bit of information on the customer. And then interestingly now, when we go and analyze the loans, we have a view whereby we can look at each individual loan and calculate the default probability as well as the expected loss. So on the left side, what we have are different loans that have been issued by this bank. We have when the due dates were, the duration, the amount, how much has been paid and how much has not, as well as the default probabilities and the expected loss. All this is being computed in real time in the back end by the algorithm and giving this information to the different loan officers. So what makes this interesting is it allows banks to come up with different strategies whereby if a loan is in distress, why do you have to wait for it to be in distress? You can actually see it as it heads to distress on a dashboard and allows you to put in mitigation measures. Now, assuming you're a big bank and you're monitoring a portfolio of maybe 100 million or even larger, let's say 40 billion. How then do you zero in on this individual accounts? So for a loan officer to go through all the loans, it becomes difficult. So what the dashboard and what this tool does and the algorithm behind it, it helps your team to zero in on specific loans that they should be paying attention to. So for example, let's take this customer here, loan ID 5282. On the right side, we have the information pertaining to that customer, IT consultant, male, age 33, county in Lamu, right? Balance, we can see 600,000. On the left side, we can see his account transaction history over the last 2 years. And we can see mostly he has a few inflows, but more or less has more outflows. So the algorithm is taking into account all this different information and is calculating this score here, and as well as the expected loss. So the expected loss, of course, as provided by FRS 9 here, we have the computations being done in the back end to allow for provision to be done. So all this computation is being done using historical data. So you've been interacting with different customers, you have the data in the bank. So the idea is, how do you leverage the existing information you have to enhance how you mitigate risk within the institution? So all this information is contained within the dashboard that allows you then to have access to this at a click of a button. And besides just the individual loans, it also gives you the allowance of seeing the sector overview, whereby you have a forecast of how the algorithm anticipates your loan book will perform. So you can anticipate some dips, and as such now you move away from having to manually compile these different spreadsheets and you know how long it takes to like put together a report. Now you move away from that and now start working with the different levels to adjust the different levels in order to influence what the future would look like, right? And so that's what the focus helps in. It shows you, based on what mitigation measures you're putting in place, what is the likely scenario to happen. And of course, with the confidence bands included. And then on the right side, you have the different default probabilities by counties. So you start to understand geographically how we're performing in terms of loans. Are there some counties that are performing worse than others? Can we actually put in place different measures maybe to go into those counties? Can we understand what processes have been put in those different regions that causes them to be problematic? And you have this information continuously streaming in and you can monitor it. And then on the bottom left, you also have now the different sectors, an overview of the different sectors and how they're performing. And so this again allows you just at a click of a button, for example, health and nutrition. If you click on it, it gives you this product, health and nutrition, largely focused on Nairobi County. It would give you a focus depending on how the last few years have been, and you have all this information. Then interestingly enough as well, you can see a 0 appearing here. We know that data quality is the responsibility of every person in the organization, right? And so the dashboard also allows you to monitor the data quality. For example, this 0 here is an erroneous entry. And so as you use the tool, it also allows you to keep improving your processes, how you capture data, how often it trickles in, and all that is accessible. Now, finally, one thing I might add is, as we have this dashboard tool, of course, governance is a very important tool. And what such a dashboard does is it allows you to distribute this tool to different members across, for example, different counties. And they would have information related to them, about them, and that they can easily be able to access and utilize. Beyond this, of course, other modules can be extended, for example, automated reporting. You also have fraud modules that can monitor transactions continuously within the bank. So looking at things such as transaction velocity, transaction location, and you have all these different things within the dashboard that will allow you to see the different touch points of the customers and flag potential fraud cases that then the fraud investigation team can focus on, as opposed to, again, trying to sift through or being reactionary. So after the fraud happens, but you can actually see it as it's ongoing. And that's the overview of the dashboard that I had for today. Thank you very much.
Yes, so thank you very much, Theory. And maybe just to conclude is to always just keep in mind the various types of dashboards. So the dashboard could be done such a way, is it a strategic dashboard? Is it operational, or is it analytic? So that at the end of the day, you see what the CEO will want to view at a click of a button will not be the same thing as what a manager at a certain level want to see. It's not the same thing as now what people at the operation level want to see. But the key important thing is at the back end, you have your machine learning models incorporating all that AI can do for you to be able to come up with that data-driven decision making. Thank you very much. And I welcome questions. I think the next is the discussant. Thank you.
Thank you, John and Joseph, for a very insightful presentation on the opportunities within AI that can be explored at the banking sector. So for this session, I think it's not a typical research session, but it's a methodological session. It's an opportunity for us to gain insights from practical techniques that can be used to solve some of the problems that exist in our marketplaces. And at this point, I think I would want to invite Andrew Njeru again from KCB to provide some feedback on the methodological session, even as we open up to the rest of us soon after him to provide any questions, comments, concerns, or directions that you think can also be explored going forward, that would be of interest to us. So I want to check whether Andrew is on. Andrew? Andrew, you can hear me? Okay, as we try to get Andrew to connect in, I can read out some of the comments and questions that have come through online. So one of our participants called Brian Michael says, with data protection policies, the trend may seem faster than the legal frameworks, meaning the adoption of some of these technologies may seem ahead of the legal frameworks. And banks may need to align themselves to the new inventions and developments in data analytics and application. How can these legal challenges be dealt with? That's a question from Brian Michael. Then Karen Kantai says, please advise on the last bank you mentioned with the SME experience. I think I missed. She's saying that she missed that. There is also a question from one of the participants who is also trying to gauge. Of course, this must have been an economist who was asking this question, saying that, yes, it's a good presentation. Can we consider bringing in information asymmetry theory into the whole picture? So, because definitely we are trying to reduce that asymmetry. How do we position our discussions around the theory on information asymmetry? Maybe as we continue to get Andrew to dial in, we can get feedback on that. Or any other participant, or there is possibly for John and Joseph, we could
Probably I could
get
comment.
a round of. Oh yeah, Andrew is in, so we can get his feedback, then we progress. I think there was already a hand up, so we'll consolidate together. So Andrew, you're welcome. Please progress.
Yeah, thank you. I think that's a very good presentation. Some very well thought through, and I think it's something that can really be a good enhancement to the entire process, not just from risk perspective, but also try understanding the customer better using even the more modern technologies. Yes, of course, some I think of interest is to see how much support the team probably could offer to any institution that would wish to do it in terms of getting the data ready, preparing the data, because that's really very, very consuming, and it's like the Achilles heel in most of the initiatives for data analytics in banks, because the data can be quite a lot sometimes in multiple systems. Sometimes the formats are not exactly as you expect, but it's always good to step in and help the institutions to at least achieve the maximum value from such an initiative. I think secondly, we've seen some models being used. So I think that's something, I think eventually if you want to approach an institution, they would want to see whether you would accept to incorporate the models that banks have in place. Because I think most banks have developed models internally for either for scoring, for rating, both supervised and unsupervised. And if the existing models can be used in a controlled environment in such a way that banks also have the comfort that the models that they use internally, they also retain the intellectual property. And if you use the internal models, then you don't have to go seeking for approvals for new models, because new models have a very rigorous process to approve, both stakeholder involvement, then you do have up to board approval. Just risk board has to approve most of the models. So it should be good to know how flexible it is to use the existing models that institutions have. And then, of course, giving a platform such that we also retain our intellectual property. We do not want to expose too much. So that's, I think, it's kind of a bit more panel where we're able to plug in our numbers and then observe that. Yeah. I think the additional thing would be the infrastructure specifications. I don't know whether you have that, how much would be needed, and the scaling depends on the data quantity. Thank you.
Thank you, Andrew, for that feedback. I think the issues have been noted by the presenters, and at the end, we'll give you an opportunity to just talk through some of the feedbacks that we are getting. There was a hand up by Irene, then another hand by Roslyn. Then, okay, so it's eliciting a lot of interest and discussion. So we already have 3 comments coming through. Even as the others prepare, I think we have ample time to discuss this issue.
Okay, so thank you very much for that presentation. It's actually something the industry needs to think about. But my big issue is actually the data. I'm not sure how you are getting the customer data apart from the data. Maybe they provide. What about the other data? Where are you getting it? It seems like there's a lot of, I don't know, data mining of the customer data. And now with the Data Protection Act, which came into effect in 2019, we need to know how do you deal with that, assuming the customer is not consented to the data you're using. Thank you.
Okay, thank you. I think we can go to Roslyn.
Thank you very much for that presentation. That is different. It's good. It's full of grips and a little entertaining. In fact, I thought at some stage you were going to tell us that it's possible to have something to switch off somebody's mouth when they are speaking what we don't want them to hear, what we don't want to hear. Now, having said that, I have a few comments. One of them is related to what she has talked about, data privacy, so I'm not going to talk about it. But I heard you saying that we rely on structured data most of the time to do our analysis. And you are saying that it's high time we started relying on unstructured data. So I wanted to understand whether you, in your paper or in your methodological session, whatever it's called, whether you have come up with strategies of collecting unstructured data. And if it is possible to also come up with an estimated cost and the responsibility of ways to collect that unstructured data, and also whether you have some recommendations with respect to countries where it has been collected and how it has performed. Then I was wondering that dashboard for the second presenter, the dashboard that you showed us, is that something hypothetical or is it something that is a solution to banks based on AI?
Yes, please go.
Okay, thank you. My name is Mike. Thank you for the good presentation, John. I had a few issues. One of them was about data privacy. I won't touch on that because the colleagues have talked about it. But the other issue is that you didn't touch on the challenges or the risks they are in. For example, you may have soiled data. You may have collected data that is not accurate, and you may use it to make some decision. The other thing is historical data. If, for example, you are going to depend on AI assume at one point, like now there's COVID, there are challenges in hotel industry and all that. So you know, AI will believe that hotel industry those thinking and all that. So I don't know how you work around some things. Maybe to change over time. Like if the history is that this is a loss making field. So, but over time, maybe it was a few challenges here and there. So, you might need a human. So, such issues, I don't know how.
Okay, thank you. Your name, please.
Isaiah Omaya.
Oh my. Thank you for the feedback. Maybe just to add to his comment so that we cover them together. Is a concern about the morality of the user of this information, because again, information as you put it, I think John put it out very clearly. Data is good, but the information that is generated out of it and the use of it can also be dangerous in the hands of an immoral person. So I don't know to what extent this technology would require some sense of morality, even as we thrust towards adoption of some of these technologies, because it's bringing a good customer experience, but at the same time, it may worry a customer if there is too much information shared and being used by others concerning their own behavioral their own behaviors from one time to another. So we don't know the extent to which some of the considerations or the extent to which a customer can be engaged for purposes of verification of some information. And he did mention about the issue of now objectivity at the end, because there's a risk of over-reliance on technology to make decisions, and at the expense of having that human experience and interaction, and especially where a lot of decisions are being made with a forward-looking perspective. So I may be a bad customer at the moment, probability of default quite high, but I've taken some measures that are not necessarily available within the scope of AI. To what extent can I present that to whoever is using for purposes of, say, for instance, access to loans, or such kind of things? So one is a morality issue, and of course, how do we mainstream this together with the physical assessment and other human interaction assessments? That's something that I thought we also need to speak to, and of course, privacy, customer privacy at the end of it all, because some customers would want some experiences to be very private, particularly like for those going on holiday, and their bankers infringing on their holiday piece is also can be a concern. So to what degree can they actually, because they still want to experience the being online even while on holiday. Kindly, you're welcome to give your feedback on the same.
Okay, so I'll start by addressing some of the more technical questions. It's fine, eh? Okay. So there was one on first with the journey to utilize data. I think it was mentioned in the beginning. So I mean, one of the things we know for sure is that you never find perfect data, right? Utilizing data and analytics is a continuous journey. It's something that you of course have to start somewhere with. We've had a lot of interactions with different clients who we have to start from the point of just mapping what is existing and then mapping processes, and then coming up with a framework that can be used now later to utilize data and analytics. So the journey is there, the journey is long. Different organizations are, of course, at different stages. So being able to help them from where they are to a point where they can utilize data is actually what we do. And then there was a question that followed on the models. And here it was on the question of why we would want to utilize external models and not leverage the internal models themselves. So to that, the idea behind what I showed is you could plug in the internal models already developed within the organization and display the output on the dashboard. So the tool is not locked in the sense that you can't add additional models. You can actually take what is pre-existing and add it on. And beyond that, you could also include external models later developed to enhance it. Yeah. And the idea, of course, because data privacy is a very big thing, and having had numerous conversations with different banks, such a solution would actually lie on premise. So it would be something whereby the data lies on premise. The model is also being able to access that data and giving out the results. And is it scalable? Yes, the solution is scalable. But what I actually showed has about 2 million data points, which is fairly small compared to some organizations. But of course, it can take in a lot more. For the purposes of the demonstration, we had to take a sample of the data, but it can take a lot more. I could also touch a bit on the dashboard. Yes, the dashboard is an actual solution. It's not hypothetical. It does exist. We designed the dashboard as is. Of course, the design can be changed to fit the look and feel of different institutions. It's fully customizable. You can add or subtract from it depending on the needs that you have. And then on the challenges and risks that come up, of course, accuracy is always a concern, right? And rightfully so. I know you brought up the issue of the AI somehow versus the human. I would think of it as the AI with the human. So it's not one taking over the task of the other. Basically, what the dashboard is providing is an assessment score that then the human takes into account in the final decision, right? So it's something that is being done together with a human person, right? On the models, for example, you talked about changing times. A lot of the models that we're creating now, of course, have to take into account COVID, because COVID has changed a lot of things. The models in this case, for example, in the dashboard I showed, is recalibrated periodically. So it's not a static model. You specify a time whereby the model is retrained on the most recent data and is able to adjust. And we pick models that are interpretable. So the model will give you the different parameters that it's using to actually score someone. So in that way, there is also an element of a human coming into play to actually check, is the model doing the right thing? And to also recalibrate in case they think something is off, yeah? So the models are periodically readjusted to match the changing times, yeah? And then the human interpretation is also very important. The models, yes, they're built to run semi-autonomously, but it's something that a human also needs to come in once in a while to check, right? It's very important as well. And then I will let Dr. Lukuru handle the others.
Sorry, I just have to prefer to stand a bit because I'd like to see some audience and look at the face when I'm replying to a few of the comments they had. The challenge of being a lecturer, you always want to look at your participants. So I think to begin with the final question that we had from Isaiah. So I just want to put the 4 levels of analytics I just mentioned. You realize when you talk about descriptive, it's where people just try to answer the question, what is the data telling me? Now, the human part is where they come when they're looking at the diagnostics. You're asking, why is this happening? So the machine will not tell you the reasons. So it's you who will go back and look at the results and then come up and say, based on this, this has been happening. You look at the predictive, the model will tell you this is what will happen. Now, to make a decision, so what should we do? We're making losses. Can we change the strategy? We're making profit. Can we optimize that? Now, that prescriptive is the human perspective of it. So you realize, I always like quoting Let Bob Collymore when we were launching training for Safaricom employees, and he'll say, he will always want to say AI, not as artificial intelligence, but he'll look at it as augmented intelligence. So is the machine helping a human being to do better? So something she'll always be looking out for, that can the machine help you to think beyond the routine? The routine job, leave it to the computer. What now needs to be decided on, now you come in as a person to really think beyond that. And the aspect of like, yes, historical data has been showing you've been always making losses. What about the future? Exactly now. You realize if you've set up a platform to pick real-time data, things keep on changing. When I was presenting to an insurance company, one of our top insurance companies in Kenya, to the board, I showed them an insurance company in the US that uses that real-time data, and it was paying their customers during the lockdown. All of us have cars here. When we were not driving, of course, you just park your car at home and you just sit there, and the insurance company is happy. They're making money because they're not going to have any accident. In the US, now they realize we did not plan to make that money. So they give you a payback. And that comes up from the real-time data they're getting from you as a customer. They can see where you are with your car, you're not utilizing it, so they see. And of course, come everything's back to normal, you'll want to go back to that insurance company. Some of us, we had 3 cars during the lockdown, you sold a few things a peak, you'll now look even for insurance company that will give you a cheaper rate. In fact, data says people change from third, wherever, to the lower rates because things have been tougher. But if people are using real-time data, then you change the decisions you are making in the business. So that was at least an easier one to start with. The other questions are a bit tougher, so I'll start now looking at them one by one. So the aspect of data structured data and unstructured. So the method of data collection, the first clip I showed, which was kind of hypothetical, just showing you the smartwatch and everything, it's setting up an IoT devices in your business, Internet of Things. So you have sensors that can pick all the information, then you link them up again to your model. That's one aspect. The second one, and it's always a real life scenario to show people, you get to any website today, it will ask you to click on cookies. Can you accept something? All of us are lazy. We accept without checking anything. So the easiest one I always tell people is a supermarket that came in, I don't want to mention its name. It's offering a lot of discounts, unbelievable discounts. People are wondering, how is all this? Of course, they're pushing back to the suppliers, all that cost. So what do? They collect all your data, they know all your patterns, and they provide that data to the suppliers. And based on that, they negotiate what they can benefit from you. So there are cookies on each and every website of businesses. And by clicking, you're already giving your consent. Now, in Europe, with GDPR already implemented, if you say, I want to know what the cookies will be collecting, it will show you all the data they're picking from you and to who they're going to give. So if I had time, I'll have just illustrated one business in the UK to see how they do all that. And then you can decide not to or not, whatever it could be. So with the Data Protection Act in place, I know the ODPC office is still restructuring a few things. A number of scenarios will come. So as a business, you become a data handler. What are you supposed to do? How are you supposed to deal with personal data? And then how do you able to use it? With the European GDPR, it gives you a customer or a person the right to say, fine, I consented at this time, now I'm not comfortable. Can I go back and change? Give me all my data, and the companies give you back all your data. Then you can see what to do with it. Say delete, and they delete. Now, people also are coming up with businesses such that the personal data that was collected, you as an owner, now you can also sell it. So you can say, okay, KCB wants my data, fine. This is what is there, and my family has this, we can sell to you at this much. That's also coming up as a business to monetize whatever it could be. So I could give those 2 examples, Internet of Things, and then the aspect of the cookies. There are many other alternatives we can discuss maybe during the break time and see what we can share. I don't want to get into cost. That will be advisory services, and maybe I might be held liable if things don't go right. So kindly allow me not to get into that perspective. I think Theory mentioned about the data sources for the dashboard, but I just comment one thing for the region. When Theory was trying to develop his career into this, his first degree is financial engineering. Of course, now his master's in data analytics and everything. It was difficult to get data locally. Even he offered the solution. We want to do for you guys fraud analytics more. It was difficult. In the US, what has developed data science field? They have data competitions. Companies have learned to anonymize data and put it out there for people to work on them. Young fellows to really develop solutions from that available data. And that's you realize when you say, is this hypothetical? No, it's not, because we've got what people can share out there. So I do not know customers' data, but we can be able to get what we can be able to use on that. So I'll encourage the region, the sector, to be open. Let's partner. Let's find a way to really tap into what we have based on the data that we are collecting out there. Of course, in line with that is the aspect of information asymmetry, and that's where all these things comes up nicely. So all those economic theories we have, it's possible to fit into the AI models. And that's the reason why the human perspective comes in. You go and do your feature engineering, you're picking which variables to input in. Now think through, what about this changing? What can be done? Can I include in some economical aspect of it? Yes, it can be done. And that's where now AI becomes wonderful than just using the normal traditional models we used to have in the past. There was that request about Bank Inter. If you want to search Google, it's the word bank and then Inter, all combined. Bank, then Inter. It's a Spanish bank. I was just trying to see what do they have on their online today. And they have just a simple point there. They're saying, people know us. Okay, do you want to know why we are known as a mortgage bank? I know people think about us because of our conditions, but it should be because of our tools, our services, and the tips that help you to choose us. Tools, services, and the tips which they provide to the customers. So what they've done, they have the cookies, of course, and everything now that can tap into all possible data sources of a customer. So when you come in to apply for a mortgage, forever, they're able to really help you all through. So I think we can discuss with whoever had a comment on that in details and see. And the issue of a fintech incubator, they have that. So I'm sure a few banks in Kenya have partnered with Safaricom to do a number of innovations. The same thing this bank has done with Telefonica, which is one of the largest mobile companies also in Europe. And they have an AI or a data hub, just working on analytics and to see how AI can transform customer experience. Legal challenges, data privacy. I just commented briefly on what is happening with ODPC's office. So when the data commissioner will launch her strategy, things will be clearer to see what do we do as data handlers, what will data controllers also do, and then we as citizens, what are we going to do? So things will be a bit clearer later on. But I'll wish to borrow a comment from a CEO in Singapore, in fact, to specifically Standard Chartered. He mentioned RegTech will always be ahead of FinTech. So law will always be catching up with what is happening in the FinTech solutions. So innovations will always be ahead. So we can't say we are going to lock them until we create laws for them. No, otherwise M-Pesa will not be here today. So something to always think through and say, let's come up with solutions and then see what else can happen. And finally is the whole issue of morality. It's the aspect of data ethics. And I think Kenya, Africa, that's our challenge. As human beings, trust is a problem. And I always like this example from a visiting professor we had from Hong Kong. He's Korean by birth, South Korean. And he'll say, it's only in Kenya where you go to a shop, when those days we use cash, and the shopkeeper gives you balance. You've seen them counting. After they've given you, again, you also count to confirm. Because trust is an issue. You're never sure whatever it could be. And he gave an example. He'll go to a supermarket. Now it's no longer there. And he'll always just be given and he'll pocket the change, whatever it is, without confirming. So one day he decided, let me do what Kenyans do. When he was confirming, this guy added him another 500 bob. Because now already he had already learned, this Korean guy doesn't count, so I can keep the change. By the time he knows, things will be different. But when you saw him confirming, things came up. So you realize it's the issue of ethics. And now when it comes to AI, they're calling it data ethics. So technology and morality, AI versus human. How do we ourselves as people come up to realize what I'm doing is going to influence the decision that's going to be made, and then struggle to be ethical. So we've had a few trainings, and with these online scenarios, you realize when you get into such areas, even the participant tells you, can you stop recording? And then now, tufungue roho, let's open up everything. And it's a challenge. So I'll put it as something we need to work on as a country, as a sector, as a continent, that first of all, develop the trust, and then now you can use technology to really meet our best experience. Thank you.
Wow, thank you, Joseph and John, for a very wonderful discussion on AI and the potential. And of course, this is not an end in itself. I think we've just begun the discussions, and the discussions will go on formally or informally. And we must appreciate you for bringing us that presentation. So at this point, it's 10:40, and I think it's only fair that we take a health break for about 10 minutes. And also at the same time, we could grab a cup of coffee or tea. Then we get back at 10:50 to progress with the rest of the program. Kindly let's keep time so that we, including those who are connecting online, we also keep time to get back at 10:50. Thank you. Okay, good morning again. We are back for our second session that will carry two papers. The first paper is on COVID-19, policy interventions, credit growth and financial stability, and is to be presented by Gillian Kimundi from Strathmore University. And the discussant for this paper is Dr. Roslyn Misati from Central Bank of Kenya. So it's a pleasure to invite Gillian. Now we get back to our usual T ratios, P values, confidence intervals, and unrelated items. So thank you. You're welcome.
Okay, good morning. Is it still morning? I believe it is. Good morning, everyone. My name is Gillian Kimundi. Thank you, Dr. Chiriongo, for that introduction. I am from Strathmore University, and I will be presenting on a study titled COVID-19 Policy Interventions, Credit Vulnerabilities, slight change in the title, and financial instability. So, I mean, there are quite a number of things going on in that title, and I'll go through them one by one. But as I kick off, allow me to start with a quote here, particularly talking about policy interventions. And this is a quote in a book by Hyman Minsky. I believe anyone who is a macroeconomist here has heard of Hyman Minsky. Yeah? And it would not be right to talk about financial stability or instability without mention of Hyman Minsky. So in a book that was republished posthumously in about 2008, right in the middle of the global financial crisis, he made this statement: if to do were as easy as to know what we are good to do. And it's a statement that actually is borrowed from one of Shakespeare's books, The Merchant of Venice, and particularly applies to policy interventions, monetary and fiscal policies. And the idea is very simple, that monetary and fiscal policies tend to have very clear-cut objectives: price stability, output, full employment. And that's the whole idea. If to do were as easy as to know what we're good to do. I mean, all of us here are very aware of what fiscal and monetary policy seeks to achieve, but it's never an easy task to achieve. And I think central bankers across the world can agree with this. Now, we want to complicate things a bit with this study, basically add things to the plate. Over and above the usual mandates of monetary and fiscal policy, we want to consider how financial stability comes into this equation. And I'll refer to a quote by Janet Yellen sometime in 2014 at a speech she was giving at the IMF. And the question she asked is very critical: how should monetary and other policymakers balance macroprudential approaches in the pursuit of financial stability? So over and above the typical mandates that I've mentioned, price stability being at the top of most lists, we're being asked to consider how financial stability comes to play here. And that's the general idea and the key motivation behind this study that we're doing today. Against the backdrop of this, of course, we look at COVID-19 and the previous 1.5 years, particularly for the financial sector. Now, 2020 brought about a series of policy interventions that I think we're all familiar with sitting here today. And just to summarize a few, started off with the central bank rate being lowered from about 8.25% initially to 7.25%, and then finally to 7%. We also saw the reserve requirements being reduced and borrowing from the monetary policy statement sometime last year in April or May. This was supposed to effectively release 35 billion into the system. Yeah. On the other hand, we saw the Treasury implementing some fiscal measures to relieve or to stimulate spending in the economy, cushion different sectors in the economy. And we saw tax reductions all across the board, from income tax, corporation tax, VAT, etc. And of course, not forgetting the fact that government expenditure last year also picked up quite a bit. If we look at the increase from about end of 2019 to 2020, we can record about 6.2% increase year on year. But even as we talk about all of these policy interventions that come into play here, we do have to be cognizant of the credit environment that we also saw. And particularly, if you look at private sector credit, as at the end of the year last year, DEC 2020, there was about an 8.3% year-on-year growth, and central government credit was about 28.3% growth year-on-year. And of course, that goes in line with the fiscal expansion that we were seeing around the year as well. So this is what is graphed here. You might not be able to see the fine numbers a bit clearly, but I mean, generally towards the end of this graph where 2020 quarters reside, you can generally see an increasing trend in both private sector and government credit. So let me summarize a few facts here. So we saw monetary policy easing, which was meant to improve liquidity conditions in the economy, show up output, and improve the business cycle. We saw fiscal measures seeking to do the same thing, stimulate spending and production. And we did see an increased uptake in credit from both the private sector and the public sector. So the key question that we're asking ourselves here, and now related to the motivation behind this study, what do all these facts imply about the financial stability of the banking sector? And even before we go into any deep analysis, I mean, if you have gone through any financial stability reports released by the CBK in the past year, capital adequacy ratios remained resilient. So that's an aspect that has remained strong for the sector. But unfortunately, NPL ratios took quite a serious downturn. Yeah. And just like I was saying, this is actually the main reason we're looking at this. So looking at COVID-19, the policy interventions, credit vulnerabilities that may have arisen during the year, and of course, the implications that they have on financial stability. So the overall objectives of this study are twofold. So first and foremost, to understand how aggregate banking stability indicators responded to monetary and fiscal policy interventions. And I mean, of course, even as we try and achieve this objective here, key thing to appreciate is the fact that we're not just looking at these policy interventions in the COVID-19 period, but want to also be able to generalize the results outside of COVID-19, especially now as we talk about recovering from it and learning lessons from it. And secondly, and most importantly, to understand the role that the credit environment, the role that the financial cycle plays in this relationship between monetary policy, fiscal policy, and financial stability. And at the end of the day, these two objectives are in line with empirical work and a lot of conversation right now around the intersection of price stability and financial stability. I mean, just as recently as a week ago, the ECB published an occasional paper on the role of monetary policy in pursuing financial stability. Just a week ago, this same month, yeah? So it's a conversation that has really caught fire, particularly now because of COVID. A conversation that was just as relevant 10 years ago at the end of the global financial crisis. So we've had two crises to deal with, very different crises, very different amplitudes, very different effects. are we going to be making the same mistakes again once a third crisis hits, whatever it will be? Yeah. And then finally, also to be able to offer recommendations on, understanding the role that the credit environment plays in fiscal and monetary policy formulation and implementation. So just before I get into the analysis behind this paper and the results, of course, I'll just start off with a few, empirical summaries from some of the studies that have been done relating to this issue. And like I said, I mean, this is a topical issue that's being discussed as we speak in the Euro area, in the US, etc. And of course, when we talk about policy and financial stability, a lot of the focus tends to be on monetary policy, even more so than fiscal policy is concerned. And there tends to be two schools of thought here. And the first school of thought has the likes of Bernanke and Svensson, who argue that monetary policy should stick to what it is mandated to do, which is maintain maintain price stability and not financial stability. And they even go as far as to say that monetary policy is far from ideal for the macroprudential task that we are asking it to take on. Also, there's this paper by Borio in 2014, and as much as I highlight Borio here under the first school of thought, he's more attuned to the second school of thought, which supports the intersection between these two areas. But something interesting that he points out in his paper is that, achieving price stability and financial stability has proved elusive in very many regimes, all the way from Bretton Woods to post-war periods. So, I mean, it's really pointed to whether this is even possible in the first place. Now, of course, the second school of thought is what we're seeing more and more, that monetary policy should be pursued to contain financial risks. And, at the end of the day, like I mentioned at the beginning, monetary policy and fiscal policies at the end of the day do have their usual mandates, which we're cognizant they're not easy to achieve. So to add financial stability to that plate is a big ask. But I like the quote, another quote that Yellen includes in her speech in 2014, and she says that the idea is not to forget that the focus of monetary policy or fiscal policy is, price stability, output, full employment, but rather to do a more balanced assessment such that we're able to be cognizant of the risks that are there to the system, any risks or vulnerabilities that may arise due to policy interventions. In saying it in different ways, that would just be considering the side effects, the unwanted side effects that these policy interventions may have at the end of the day. So if we switch to fiscal policy and financial stability, the narrative is similar. And of course, they're opposing schools of thought. I like these two papers here because, they look at fiscal expansions in very different ways and have very different results at the same time. So Piluso and Risciuti in 2008 indicated that a fiscal expansion through government expenditure actually has a negative effect on the loans to deposits ratio for banks, which is an implication for stability. Whereas Baldacci in 2009 indicates that fiscal expansions can actually shorten the duration of a crisis. And I think that this is quite topical, especially now looking at the scenario we're in with COVID-19. Will the fiscal expansions that we saw last year actually shorten the duration of a crisis? Yeah. But this is something that our analysis doesn't really tackle. Yeah, we're not looking at whether the crisis becomes longer or shorter given certain aspects. And just adding on to the fact that the formulation and implementation of these policies is critical, Baldacci actually indicate that the way the fiscal policy is carried out is actually key. The tool that is used is key. And they particularly mentioned that if you reduce consumption taxes rather than reduce income taxes, the effect is stronger. The the way consumption taxes reduce the duration of the crisis is way more amplified than if you were to reduce income taxes. And that means that, over and above looking at fiscal policy in general and financial stability, there needs to be careful consideration of the tools that are used in the first place. And of course, just to finalize on this issue of fiscal policy and financial stability, to close it off, in a recent paper by Dumichik in 2019, they say that, he says that as much as financial stability is not a key goal of fiscal policy, or even monetary policy for that matter, some of its tools definitely have influences on the systemic risk of the sector. Finally, let me talk about the credit environment, because, going back to the title of this paper, we're looking at credit growth, credit vulnerabilities. How does it play into this entire discussion here? Now, as I talk about the credit environment, it would be important to first highlight a very interesting definition of financial instability. And I like this definition by Tobias and Liang in 2014, and they mentioned that financial instability arises when negative shocks are amplified by vulnerabilities. So even before you talk about policy interventions and the effect that they have on financial stability, you need to understand the role that is played by any vulnerabilities in the system, vulnerabilities that can amplify the effects, the financial instability effect. And this is where the credit environment comes in at the end of the day. You have quite a number of papers talking about how the credit to GDP gap is an indicator of vulnerability in the system. The BCBS, the Basel Committee, is a very huge proponent of the Basel gap, the credit to GDP gap, indicating that when it's high, that's an early warning system, an early warning indicator that there are vulnerabilities in the system that need to be taken into account even as policies are being implemented. And even as we talk about monetary policy and financial stability at the end of the day, particularly looking at the credit channel of monetary policy, it's not just about increasing the quantity of credit that is available in the system, but there are reported implications of monetary policy easing leading to quality issues. And it even borrows from the discussion we've been having in the morning about asset quality. So policy interventions have an effect on the quality of credit, and of course, at the end of the day, that translates into financial stability concerns. So just to remind you, at the end of the day, the objective of this study is twofold. First and foremost, to understand the implications of policy interventions on financial stability aggregates, and now to bring in the credit environment and understand the role that it plays. Does it have some sort of intervening role in this relationship? So I believe this is already summarized, so I won't spend so much time on this, but this is just a summary of what I was discussing. I'd like to focus on the data and, of course, the results from the analysis that we get, and finally, the policy recommendations that are coming through from our results. So I'm not going to spend so much time talking about the T statistics and the p-values, like Dr. Tiriongo alluded to, but I think it's fitting for you to understand the kind of data that went into this analysis. So first and foremost, our key variable of the day is financial stability. So we've considered 4 different ways of measuring financial stability, all the way from the more common asset quality indicators and capital adequacy indicators. So this is based on IMF financial soundness indicators, asset quality being the non-performing loans over the total gross loans, and then capital adequacy, still looking at NPLs, but as a ratio of total capital. And the idea behind this capital adequacy ratio is to understand the capacity of bank capital to withstand losses from NPLs. which is quite critical, especially for our policy recommendations at the end of the day. We also look at liquidity because the first two typically capture credit risk through the use of NPLs. But liquidity risk is typically an important aspect to consider. And looking at the relative volatility of deposits, this is another measure that's suggested by the IMF Financial Soundness Guide. Now, interesting thing about liquidity here through the volatility of deposits is that we want to see whether certain policy interventions amplify volatility or whether they reduce the volatility of deposits. And of course, the whole idea of looking at deposits here in the first place is to understand, if there's high volatility, then that means depositors are willing and are very quick to withdraw their funds from the banking system, which definitely affects loan supply. It affects the efficiency of maturity intermediation at the end of the day. But volatility goes both ways. I think we understand that. You can either have upside volatility or downside volatility. And at the end of the day, I believe banks are more interested in downside volatility. How do we manage that? So we bring in a fourth measure, which is the skew of the deposits. And there's a very interesting paper done around this by two authors, Nana and Samson, and they actually indicate that yes, as much as volatility of deposits it's a good measure of financial stability or instability, it is important to consider in what way the deposits are leaning. And typically, if you have deposits that are likely to be low, then you are more likely to face liquidity shortages in the system. So negative skews are not preferable. We want positive skews, yeah? You'd rather have an upside than have the downside. So we also use other variables, of course, now capturing the policy interventions, looking at monetary policy. We have two tools that we're looking at and comparing. So that's the central bank rate and reserves. Then when it comes to fiscal policy, we're looking at the ratio of government expenditure to revenue. And the idea is the larger this ratio is, the larger the deposit. But typically that implies that there's a fiscal expansion, yeah? Then, of course, we bring in the business cycle. So that's the cyclical component of the real GDP growth. We also bring in inflation, the intermediation spread, and finally, the financial cycle. And this is what I was talking about related to the credit environment. So we're going to get into this in just a bit. Now, let's talk about this credit to GDP gap, because like I said, the idea of this analysis is to see whether we can understand the effect of policy interventions, or rather the response to policy interventions, given the credit environment that we have at play. So the credit to GDP gap is also referred to as the Basel gap. And as you can tell, it's an indicator that has been, it's an indicator by the Basel Committee and the BIS, of course. And the idea of the credit to GDP gap is very simple. We want to understand how should credit relate to GDP. And if there is more credit growth than there is GDP growth, then that might actually be unjustifiable. If the economy is growing at a slower rate than the credit is, then that's not sustainable, can't be justified, yeah? So the idea of the credit to GDP gap is to take the ratio of private sector credit to GDP and deduct the long-term trend from it. And the long-term trend here is an indication of what you'd call the sustainable evolution of this ratio or the economy in general. So that's why we're calling it a gap, yeah? And if you have a positive gap, then that indicates that credit growth is much higher than GDP growth, which, like we said, is unjustifiable. And this is where the vulnerability comes in, because, again, it's unsustainable. But if you have a negative gap, then the idea is this is an unexploited opportunity. There's room for additional sustainable borrowing in the economy. So we have the two scenarios, yeah. And if we look at the credit to GDP gap, it is a very good indicator of the financial cycle. The fact that you have upward and downward financial cycles, yeah. So just to give a bit of perhaps econometric background to this, the credit to GDP gap is extracted from what we call the CF filter, the Cristiano Fitzgerald filter, and it allows us to separate the cyclical component of the credit to GDP ratio from the trend component. So on to the estimation methodology. Again, I won't spend so much time on this. But we are going to be using a Bayesian methodology in our analysis, what we call a Bayesian vector autoregressive model. And one of the reasons that we went with a vector autoregressive model here is so that we could understand the response to impulses in the policies. Yeah. So if monetary policy is shocked or fiscal policy is shocked, then how do other financial stability aggregates respond to that shock? So vector autoregressive models allow us to do that. And we go the Bayesian route, I mean, because Bayesian analysis has become a very key tool for central bankers now, particularly in understanding and giving your results a probabilistic interpretation. Yeah, with some of the impulse responses that we'll be looking at, we'll be looking at the average response that is expected from these shocks. Then what we're also going to do, just so that we make sense of the results that we're going to be seeing, is have different models, or rather separate models, depending on whether we have a positive credit to GDP gap or have a negative credit to GDP gap. And that's where the threshold aspect of our model comes in. So if the credit to GDP gap is unsustainable, then we have a model explaining the relationships or the dynamics between policy and stability. And then again, if we have unexplored opportunities, then we have another model that shows us the dynamics in such an environment. Just to indicate this for any statisticians or econometricians in the room, any Bayesian modeling requires you to specify a prior. So we're going to be using the most widely used prior in any VAR model, which is called the Minnesota prior. Gains the name from the Federal Reserve Bank of Minnesota, where it was originated. So I don't believe this is very critical for us at the moment, but just to indicate that our VAR models, the vector autoregressive model, will be using one lag each based on the results that we get here. But I'm just going to first start with this graph here. And given that our threshold is defined by the credit to GDP gap, it would be interesting to see how it looks like, especially in the COVID-19 period. And this takes me back to the title of this study, COVID-19 policy interventions, credit vulnerabilities. So we need to bring in the COVID-19 aspect. How does it come into this analysis? Interestingly, when we look at the solid black line, that's a representation of the credit to GDP gap. Now, the bars that you see, the sort of pink bars that you see, are the business cycle. So with this, you're actually able to see how the credit to GDP gap relates to the business cycle, or rather the cyclicality in GDP growth in the economy. And typically, you can tell a few things from this graph. That first and foremost, the financial cycle as represented by the gap, it's quite volatile in comparison to the business cycle. If you can look at the amplitudes of the financial cycle, that indicates more volatility as compared to the business cycle. And also, if you look at a simple correlational analysis between the two cycles, the financial cycle and the business cycle, you can infer that the financial cycle precedes the business cycle. So an expansion in the financial cycle typically comes before an expansion in the business cycle. But what I'd like to point your attention to is what we have at the end of our chart here, which is reflecting the 2020 period. And interestingly, you'll find that around 2020, the credit to GDP gap quickly picked up into a positive area. Again, which is an indication that the COVID-19 period can be characterized as this sort of vulnerable environment, a vulnerable environment with a high financial cycle or with financial imbalances. That credit growth in this 2020 period was higher than GDP growth. And of course, I mean, there's typically a lot of contention around this gap measure as it is. I mean, there's no consensus around whether it works in certain jurisdictions, yeah? But as we have it here, the COVID-19 period is being characterized as a vulnerable credit environment. So as we get into the analysis, that's what I want us to keep in mind. Yeah, so finally, to talk about the results that we get, and I'll just indicate a few pointers around this. So what we're doing is shocking our policy measures. So we'll have the CBR, the central bank rate. We'll also have the reserves and also have the fiscal measure. Yeah. So just to explain a bit about this, there's a reason why we've indicated a negative shock here. And it is to align to what we were seeing in the COVID-19 period. So to understand how the negative shocks to CBR and to reserves affect financial stability indicators. We talked about the NPLs, we talked about the depository measures as well. So I don't believe you'll be able to see this very clearly, but these first two here are the responses by the NPL ratios. And then finally, we have the third column is always the deposit skew. And finally, we have volatility of deposits. Then just to give you a quick legend here, if we're dealing with a high credit environment, or basically where the credit to GDP gap is positive, the results are indicated here in blue, and then a low credit environment is indicated in the orange here. Then the D here is just an indication of the type of effect that we are seeing. Are we seeing a destabilizing effect, or are we seeing a stabilizing effect? So D versus S. Null would imply that the effect was quite negligible for it to mean anything, okay? So as you can tell, the negative shock that we saw to the CBR last year, I mean, generates quite distinct patterns in the different stability measures. But you can tell the blue lines here, like I said, represent a high credit environment. Which is what we were characterizing COVID as, whereas the orange lines characterize a low credit environment. So I believe what we can see from this is first and foremost that when we have a positive credit to GDP gap, that negative shock to the CBR actually increased, or rather causes an increase in the NPL to total capital ratio. And this is over the next 20 quarters, yeah? So if the shock was implemented at a certain time period, what do we expect over the next 5 or so years? And we can see the response in the capital adequacy ratio here is that it increases, which is, it's not a good thing, yeah? We can also see that when we shock the CBR, particularly in a high credit period, then there's an increase in the skew of deposits. And this is a good thing, as you can tell from the S that is here, the stabilizing effect here. And the whole idea here is quite simple, that at the end of the day, if we're working with a high credit environment, credit creates deposits. So it's quite likely that your deposits are going to be high. But now the unfortunate thing is that when we see a negative shock to CBR, like what happened last year, this increases the volatility of deposits in a high credit environment, particularly. And I mean, even from the graphs, you can see that the response of the financial stability aggregates is very different depending on which period you're looking at. And you know, one of the things I was asking myself as I did this analysis is, why is it that volatility of deposits is likely to become higher as we trace out the effects of COVID-19? And I mean, it could partially be attributed to some of the sectors that we see making up majority of loan portfolios in banks. You have trade sectors, retail sectors, agriculture, personal and household loans making up the bulk of loan portfolios. And if that is the case, if loans or credit creates deposits, then it would be understandable why then there's a higher volatility of deposits. And of course, this is associated with a liquidity risk. Yeah, chances of liquidity shortages are higher when volatility of deposits is higher. When we look at the reserves, a shock on the reserves like we saw last year. So again, we're dealing with a negative shock to the reserves. Again, we're able to see very different effects. And I mean, if we focus on the blue responses, which pertain to a high credit environment, we can tell that all across there was a destabilizing effect. Yeah, that if there's a negative shock to reserves, if reserves are reduced, then all our financial stability indicators are expected to be detrimentally affected. And I mean, this even calls into question, like what I said earlier. Should there be key consideration into the tool that is used? So, in as much as they're the usual mandates of monetary and fiscal policy, in terms of financial stability, it looks like the different tools of monetary policy have very different effects at the end of the day. Now, finally, as I head towards a summary of all this and the policy recommendations of the same, I'll talk about the fiscal measures here. And again, here now we changed the scenario. What we saw last year was a fiscal expansion. Tax reductions, but an amplification of government expenditure. So again, you'll notice, and this is quite surprising, that when now we look at the blue line, again, relating to a high credit environment, this fiscal expansion actually helped reduce the NPL ratios, which is stabilizing. But the only detrimental effects that you're going to be able to see from a fiscal expansion would relate to deposits. So fiscal expansions are detrimental for deposit skews and detrimental to deposit volatility. Yeah, and I mean, again, this even brings us to the question of how aligned should these two policy worlds be? Is there some sort of emergent monetary fiscal nexus that we should be looking at? Because both of these are expansionary policies, both monetary and fiscal, but the results they have are very different. So this is just a summary of the results here. I won't spend so much time going through this, but I think one thing I should indicate is the fact that if you look at the results in a low private sector credit environment, now if you look at the orange line, a fiscal policy expansion in a low credit environment actually has destabilizing effects. And this could be partially attributed to crowding out effects, that a fiscal expansion which is supported by increase in government credit is closing the door on private sector credit, the orange line, then we're likely to see adverse effects on the financial stability of the sector. So it means that even as fiscal policy measures are being put in place, the typical crowding out scenario does need to be taken into consideration. How does private sector credit look on the other side? So I'll quickly summarize this because I believe I've taken quite a bit of time. Yeah. But basically what this graph now indicates is the fact that when we look at the usual policy mandates of monetary and fiscal policies, now forget financial stability for a minute. Are we able to actually achieve any positive effects on price stability or on business cycle, given some of the policy interventions that we saw last year? And just to summarize what this is telling us here, it's an indication that when you have a high credit environment, lower reserves actually do a good job in shoring up the business cycle, which is the intended output that was expected from last year to stimulate the economy. So lower reserves were able to do that. But the policy rate reduction was not able to do that in a high credit environment. So just to summarize all this and of course issue the policy recommendations, first and foremost, we can tell that monetary and fiscal policies have clear implications for financial stability aggregates. And I guess it's based on this summary that you're seeing in the table here, that given the different policies that you see, given the different shocks that you see, you're able to see differentiated effects on the different financial stability aggregates. And going back to the general recommendation that we stated in the beginning, this typically calls for a more balanced assessment of policy interventions, taking into account the pursuit of financial stability in the background. Secondly, the fact that policy effects on financial stability aggregates definitely vary depending on the credit cycle that you're looking at. And I mean, you can already tell that in a high credit environment, the effects are very different from a low credit environment, and particularly worse off in a high credit environment. And of course, this calls for additional consideration of prudential policies that need to be put in place, considerations that need to be put in place when we're dealing with a vulnerable financial cycle. Now, thirdly, based on something I mentioned earlier, there seems to be this lack of synergy between monetary and fiscal policy actions. And just to give you a preview, I'll highlight this behavior of the NPL ratios in high credit environments. You'll notice that monetary policy expansions are more likely to destabilize, whereas fiscal policy expansions are likely to stabilize the same ratios. So it seems like there is no synergy between them. And, at the end of the day, this is quite understandable because, some of the policy interventions that were put in place over the past 1-2 years were basically responses to COVID-19 primarily, and not necessarily the outcome of some monetary fiscal nexus, yeah? But going forward, this is a recommendation that at the end of the day, there is a requirement for a cohesive formulation and implementation of this different policies in line with financial stability agenda. Fourthly, just to summarize, the choice of monetary policy action is clearly dependent on the credit environment that we are seeing. And I think we're able to see this from what we see with reserves, that in a high credit environment like what we saw in the COVID-19, reserves do quite a number on the financial stability aggregate, which is quite unfortunate because at the same time, lower reserves were quite efficient in shoring up the business cycle. So you end up with a trade-off. Do we focus on financial stability or do we focus on the usual mandates of monetary policy? And, at the end of the day, it calls for the use of reserves as a policy tools in a high credit environment to be carefully assessed. And this is where the internal control mechanisms come in place. This is where macro and micro prudential control mechanisms come in stronger. And I mean, if you look at the conversation around the ECB around now in the Euro area, there's a lot of talk about counter-cyclical capital buffers, that the capital buffers banks are putting depend on the credit environment that you're seeing. And finally, now beyond the COVID-19 scenario, given that we saw negative shocks, if we were to flip this and now consider positive shocks, increase in the CBR, increase in reserves, tightening of monetary policy, you can see how the picture looks drastically different. What we saw as destabilizing now comes as a stabilizing effect. And as I conclude this, the question we need to be asking ourselves is this talk around leaning against the wind actually relevant? That around vulnerable or unsustainable financial cycles, we should actually be going with tighter monetary and fiscal policies, yeah, rather than cleaning up after the bust, cleaning up after the crash, yeah. So I will leave it at that, and I invite any questions and comments from the discussant and the plenary. Thank you.
Thank you, Gillian. I didn't warn you that the person to present was actually a lecturer. And must apologize for not warning us. But nevertheless, I guess if she was to be given more time, she would say more and more. But thank you for a very clear presentation on the COVID-19 policy interventions and credit vulnerabilities. And of course, how all this come together to influence financial stability. To discuss this paper, I think we have another very strong speaker. It's called Roslyn Misati from the Central Bank of Kenya. And the paper could not find a better discussant than her. So let's listen to her before we open it up to the rest of us. So thank you and welcome, Roslyn. Yes.
Thank you very much for giving me this opportunity to make some remarks on Julian's paper that has been excellently presented, powerfully as usual. She usually does a powerful presentation that makes me very proud of her. So, and a well thought out paper. So to give my comments, I would first of all give a general overview, then I'll give maybe specific comments from the paper. So the paper sought to investigate the effect of monetary and fiscal policy intervention on financial stability in the context of COVID-19. The topic is loaded, as you can see. There's fiscal policy, there's monetary policy, there's credit vulnerabilities, and there's COVID-19. But from the way she has presented, I will not say that statement again because it has brought it out well. Because initially I thought, what does credit vulnerabilities have to do with it? In any case, isn't monetary policy implicitly? I mean, credit vulnerability is not implicit in monetary policy? Because when monetary policy is being implemented, one of the way it affects the economy is through the credit growth, and therefore vice versa. So I thought, why should it be standouts? But from the way she has presented it, now I understand why she had to put it in the. Otherwise, I could have recommended for it to be dropped so that the topic can come out clearly. To focus on monetary and fiscal policy intervention on financial instability. It's an important and relevant study, given the fact that monetary and fiscal policy, when they are implemented, the interventions, it's important to be able to do proper interventions. So because it has an impact on lives of people. So the paper is relevant and it's important as far as the economy is concerned, and of course, how it is associated with financial instability. that is general. Now, in terms of the specific comments, I start with the background, or rather the introduction of our study. I'm just going to say how it can be improved, how it can be made better. And I find when I was reading it, I found that there were the linkages between financial policy monetary policy, fiscal policy, and financial instability were weak in terms of the theoretical underpinnings, the transmission mechanisms from fiscal policy, monetary policy to financial instability. They are not brought out well. There are clear channels, clear transmission channels, how monetary policy and fiscal policy affects financial instability. So I recommend that the paper, for it to be better, to move to the next level, it is important to clearly provide the transmission mechanisms from CPI, for example, which is a monetary policy action, and from government expenditure, for example, which is a fiscal policy action, how it transmits, the channels through which it transmits to financial instability or financial stability for that matter. Then I also found in the paper, in the introduction, the rationale doesn't come out so well the way it was brought out when she was making the presentation. First, because of that missing theoretical linkage, and also because of bringing a lot of stylized facts in form of charts within the introduction. So I thought it would be better to isolate those trends and put them in a separate section where you analyze the dynamics, the evolution of those variables. But in the layout, you bring out the key message. I mean, you develop in a consistent manner how your paper contributes to the existing work. What is the gap that you're filling? What is your contribution to the existing literature? What have the previous studies talked about it, particularly in the context of Kenya? Is there any study that is related to that? Then I was also wondering, in the case of the methodology, you have not given us a rationale. The author has not given a rationale for picking the particular indicators that have been picked for the study. For example, why did you pick government expenditure as opposed to the budget deficit, or as opposed to tax measures? In any case, if you are talking about COVID-19, there were a lot of targeted tax measures. So why did you pick, what is the rationale of picking some indicators and not the others within your study? Then it is also not clear in the methodology. You refer to the fact that you are using data that is built from a sectoral point of view. But it is not clear yet when you look at your variables, they all look like macro variables. So the reader does not understand, or the reader gets lost, whether you are using micro level data, sectoral data, or you are using macro data. Were you using bank specific data, or you are using the macro variables? The variables you have are all macro variables. Yet you have said in your study that the data was built from a sectoral data set. Then I was also wondering whether you considered using a composite index for your financial stability indicators. Because we know that the financial stability indicators of some segments of the financial system are really interlinked, interconnected amongst themselves, and also with the real economy. So probably it could be easier. And also the propagation of the transmission, the shocks from one sector to another may be so complex, including nonlinearities, such that it may not be easy to just pin the indicator on one isolated measure. It may make sense, or it may be important for you to consider a financial sector index, financial stability index, like a composite index. And then I was also wondering, you tried to show us how you accounted for COVID-19. At first, I was wondering, which I answered myself, because I know you don't have enough data. I could have suggested that you demarcate the periods, but I know you don't have enough data. So I told myself that is not possible. But nevertheless, remember that during this period, when the period you have picked, you picked 2005 to 2021. Within this period, a lot has happened in the financial system. I saw that you acknowledged the fact that the interest rate cap was in place and it was removed. It was actually removed just before COVID kicked in. So first of all, I did not see how you controlled for the interest rate cap. I didn't see that. And secondly, even if you were to control for that interest rate cap, how do you isolate the effects of the interest rate control and the COVID-19 period? Because the interest rate control was removed in November 2019 and COVID started in March, and you're using quarterly data. So I think you need to think loudly on how to incorporate, because those events are important. Both the two events are very important, and especially the interest rate cap, because it had implications on credit growth dynamics. And in addition to that, you also may want to consider this one. I don't know how you can consider it, but it's something to think about or even acknowledge the limitation of your study, because even during all these events, they are also amplified by the fact that within the financial system, which you are considering, digitalization became a key thing following COVID-19. It was already there from, your data includes it, from 2007, but over time it has been becoming more important, and it became even more amplified during the COVID-19 period, because there were measures that were put in place that were targeted at making it, encouraging people to use cashless more than cash. And you see there's the issue of entrenched habits. And then who wants to get COVID anyway? Why would I want to catch that money rather than so it was amplified. I guess you get my point. So you need to think, I don't know how you will be able to capture it, but you need to think about it, because all those things, they have implications for the credit cycle, and they also have implications for the evolution of credit growth. Given the fact that that is your main thing that you're using to analyze your study, you cannot ignore those facts, because that reflects what is happening in practice within the economy. Then you talked about monetary policy using different tools, having different outcomes, whereby you said that when the reserves are used, the reserves are better in your conclusion. Usage of the reserves is better than commercial bank reserves than using the policy rate in terms of the financial stability outcomes. So I was asking myself, first of all, these are different. They are supposed to be different anyway. The reserves were targeted at the sectors that were having problems with COVID. That's one. Secondly, there are lags in terms of the transmission of the policy rate. But more importantly, the implementation of these two policy actions was done almost at the same time, and they are expected to have the same effects. So you need to explain why we are having different outcomes. Because if you are talking about easing through reserves, and also talking at the same time about easing using the policy rate, the transmission of that policy rate is expected to have an effect, not just on the prices, which is the lending rate, but also on the quantities, which is the variable through the various monetary policy transmission channels. So we cannot say that the fact that there was easing of commercial bank reserves, when you are considering that, we need to explain why we are having different outcomes, because we expect the outcomes to be the same. So we need to explain why you need to explain why your results are showing different impacts. Of course, taking into account the fact that the way the transmission is different, and also there are lags when it comes to the policy one, and the other one was targeted. Then on your page 19, I'm sorry, I have to be specific on this one, because I found you deviating from your main objectives. Your objectives are two, and they are clear. The second one had given me trouble initially, but I understood it when you presented it. Your first objective was to investigate the impact of fiscal and monetary policy on financial instability. The second one was, of course, they're interlinked. Whatever that you are doing is within the credit environment. Then you started now telling us about how the business cycle responds to monetary policy. Of course, I know that that credit to output gap is related to the business cycle, but I find it out of context, even the way it just jumps into it. It wasn't being mentioned so much before, unless you want to make it an objective. I could recommend you drop it unless you want to make it an objective. So you have two options. Either you make it an objective and you consistently integrate it throughout the paper, or you drop it. And then you have made a conclusion about the synergy between fiscal and monetary policy. And the reason why you are concluding that expansionally, fiscal and monetary policy are not coordinated is because you are getting different outcomes. I beg to differ that I don't think that the fact that you are getting different outcomes necessarily means that there is no synergy. Because first of all, if you are considering the fiscal policy measures that were implemented, the fiscal policy measures were unique. Unlike the monetary policy measures that are kind of standard, the fiscal policy measures, some of them were quite unique. They were targeting vulnerable groups, some of them. Some of them were targeting civil servants. And even if they were standard policy measures, the fact that they are giving different outcomes does not necessarily mean that there was no synergy. So for you to be able to understand whether there was synergy or not, I think you need to do much more. And also you need to describe the nature of these policies and what was expected. Because the outcomes were not necessarily going to be the same. Of course, some were supporting business, some were supporting people, and they're also interlinked. Because for example, the tax measure, if I can give you an example of the tax measure that was given to civil servants, and it was known upfront that there will be a tax relief over a period of 1 year. That tax relief can make me go for a loan. So you see, it is like they are so interlinked. So you need to discuss those kind of dynamics. Thank you. Thank you very much. The paper was wonderful. I enjoyed it.
Thanks, Rosalind, for a very comprehensive review of the paper. Evidence definitely that you went through the paper line by line, page by page, and word by word. So thank you for a wonderful review. I'm sure the comments that have been made available to the writer, and indeed to all of us, are really quite interesting, insightful, would go a long way in shaping the paper going forward. Just to clarify a few things, just to what is coming out generally is the issue of where there are innovations in the paper. I think it's important for readers to appreciate the innovations. Where you're picking a new measure for a particular metric, it's good to provide a little more explanations around it. And of course, why you're deviating from standard measures is also critical for the readers to understand. Of course, we encourage innovation, but under the guidelines of very specific justifications. One thing that I thought was burning and I needed to emphasize was the issue of the credit to GDP ratio. Of course, in the measurement of that gap, that whenever there is credit growth higher than GDP growth, then you have a positive gap. But I don't know the extent to which you have appreciated that the relationship between credit and GDP is not necessarily instantaneous. The fact that there are lags in between, how is that accommodated so that an expansion in credit does not necessarily create economic activity within the same period, but that can actually take much longer. Now, the appreciation of the lag structure would be critical. The other aspect that places this paper is at the center of this paper is either the interdependence or independence of either of the policies on each other. And of course, that takes us to the discussions around whether there is fiscal dominance or monetary policy dominance over issues around financial stability. And of course, the discussion has highlighted the aspect of the transmission channels. How do we expect fiscal policy, for instance, to affect financial stability at the end of it all? Then there is another issue about capital adequacy that I thought the measure was was also unique. It was an innovation around it because there are standard measures of capital adequacy, which is actually either the core capital to total risk-weighted assets, either the core capital or total capital at the end of the day, which actually are very statutory requirements on the part of the binding constraints to that extent. So why we are moving away from those known measures is something that, of course, needs to be explained much more. And the other aspect is, yeah, I think this was covered by the discussant on the issues around fiscal policy and monetary policy interactions, because in an environment where you have both monetary policy and fiscal policy being adjusted because of a shock such as the pandemic, there are aspects that were necessarily converging and there are those that were diverging. So is it possible for the reader also to get an appreciation of moments within the scope of the paper where monetary policy was pulling in the same direction with fiscal policy and where they were actually pulling in different directions? Of course, each of them pursues divergent objectives at any given time, but there are moments when they come together, and that can easily be very central in influencing the results that we see at the end of it all. So it's important to appreciate what each of the policies were actually pursuing and describe that environment a little more. So thank you very much. And I think we would invite a few comments in the interest of time before we progress to our last paper. There is a hand up by Irene and Camilla and Faith.
Okay, thank you very much for that paper. I had two questions, but one has been highlighted on the choice of the variables. I had trouble with the choice of the NPLs, net provisions to total capital, and yet we have the capital adequacy ratios. Maybe you need to justify maybe in the paper why you use that and not the other one. Then two is on the capital buffers. You mentioned something about the countercyclical buffers, which is not implemented in Kenya, but in return, we have the capital conservation buffer. So I don't know if you considered anything on that, now that these buffers, capital buffers are there to be used in case of a crisis. And you can say in the COVID period, it's a crisis of this end. So did you consider those capital buffers? Thank you.
Okay, thank you. Thank you, Irene. I think Camilla can take it, then Faith.
Okay, since I have the microphone, maybe I could go first.
Okay.
Yeah. So thank you for a very well-detailed paper, and certainly we'll be looking forward to the improved version. I equally had concerns about your choice of variables, and I think it's been well elaborated by the discussant as well as Dr. Tiriongo. But perhaps I could just reinforce the need to really justify specifically the measure of vulnerability. In this case, you're using credit to GDP ratio, unless you're telling us both the regulator and the government and the private sector. I mean, from us where we sit as bankers, we appreciate that credit is still quite low. By global standards, Kenya credit to GDP ratio is just about 25-30%. It's still considered quite low. So at what point, maybe your paper could bring out at what point does this become destabilizing? So maybe some pointers there. So even as you recommend to policies that yes, this is a good measure, then we know what threshold becomes that inflection or tipping point. And also maybe for area for further study, I know you really highlighted 2020. And when you're measuring credit growth in 2020, I know this could be a challenge. Are you able to tease out or control for the capitalized interests during the restructuring process, we've seen banks are capitalizing interest that was the interest payments that were not made when they were due. And that is pretty much what is explaining part of the growth that we're seeing within credit. Yet from your graph, it would suggest we're still in a high credit environment. So it would help to get some insights on that. Thank you.
I'd like to start by appreciating the author for a very interesting and relevant topic. My comments are basically with regard to monetary policy and the rule of thumb by John Timberjan regarding one policy, one tool, such that in situations where there are competing policy targets, then there would be clarity on what the purpose of that policy is. And so how would that rule of thumb fit into this? And that also ties in with my second point, the question about whether monetary policy tool is suitable for pursuing a financial stability goal in a developing country such as Kenya. You quoted ECB talking about monetary policy stabilizing financial stability, but I think it's important to appreciate the differences in terms of the low interest rate environment that they're facing, low inflation, more complex financial markets, and then to kind of compare and contrast whether monetary policy would then be suitable in an environment such as Kenya, where price stability is key, and we know about the interest rates and the price pressures that we face that are different from the European market. And then the other comment that I had was with regard to the credit to GDP gap. A positive gap is also known to measure a recovery in financial intermediation. And so I'm wondering whether what you are picking, as Dr. Misati alluded to, is actually a recovery in credit in the period of 2018, and also tying up with what Faith mentioned, the threshold given by Basel that credit growth, particularly credit to GDP gap of below a certain threshold would not be overheating and therefore would be sustainable. And given that when we looked at the charts, the levels that you pointed out in 2020 were much lower as compared to other periods that maybe had a little bit more crisis, particularly in 2016 and other periods prior. So how can we contextualize what we were seeing in 2020 as either a recovery or an overheating? And my final point is with regard to the channel through which fiscal policy affects credit risk. This, I guess I can raise as a question. My initial intuition would be that the fiscal policy would lower credit risk, particularly if taxes were lower. It means that disposable income was lower, therefore the ability to service loans would be much higher, which would lower credit risk. So I was a bit confused maybe as to how fiscal policy had a different effect. Thank you.
Okay, any other final comment before we focus? A burning comment, maybe a final comment, is the issue of, I know in the paper, the focus is really on the monetary policy interventions. And yet during the time of COVID, there was deployment of both monetary policy, but there was also some other regulatory measures that were taken that were not necessarily monetary policy. It was touching on prudential guidelines, things around loan loss provisioning, loan classification, and loan restructuring, which have implications on stability. So how do we bring all those aspects together at the same time? Then a final one is about I know the requirements about the conventional classification on credit to GDP and overheating discussion. There were times in Kenya when we had some sectors of the economy growing very strongly, yet if you saw credit, it was very low, very muted. So, of course, raising questions on what's funding growth. So it seems also there are divergences in terms of financing of growth that is not necessarily led by credit. So of course, there would be considerations on overheating, but what's the reverse of it? What's the reverse of overheating? Is it the economy is in a freezer or something like that? So those are some of the dynamics within that ratio of credit to GDP that we, I think, need to highlight in the course of our discussions. So in the interest of time, ladies and gentlemen, I think it's now time we moved to the next presentation, which is actually our final one for this day, is on diversification, loan loss provisions, and bank earnings during the COVID-19 pandemic. Evidence from Kenya. It's going to be presented by another veteran author called Rogers Ochenge. Dr. Rogers Ochenge is a faculty at Embu University and Strathmore University. And the discussant is Dr. Caroline Kariuki from Strathmore University, is a colleague to Roger. So we hope that we will, there will be still objectivity even in as much as the two colleagues. So I invite Rogers to make the presentation then as we progress.
Let me just disconnect this. Okay. It's okay. I can just.
Okay, good afternoon. Thank you so much for an opportunity to present this work. It's on diversification and loan loss provisioning with a particular focus on COVID-19. But of course, we know COVID-19 has not been there for quite long. So in most empirical analysis, we cannot purport to be really doing a lot, but we will touch on the preliminary results or more of exploratory analysis. So let me start with diversification, and this is an unsettled old question. And the question is, does diversification to non-traditional income sources confer a bank an obvious benefit? You know, like portfolio theory would suggest if we consult finance. There are, varying conclusions. Stiro 2004 finds that a shift to non-interest income sources actually increases bank risk. So as the bank tries to maneuver in different, some uncharted waters, that can increase its risk and so lower the risk-adjusted profits. That means, yes, it might get profit, but if you consider the risk involved, that could reduce the risk-adjusted profit. Another author actually makes an interesting observation that some non-traditional business lines actually do increase bank failure. For instance, if a bank goes into venture capital, into investment banking, into securitization, they do increase risk and therefore risk of, increased chances of failure. But there are other business lines that are actually beneficial, such as brokerage, insurance sales, and maybe some few other lines. So there is no obvious conclusion you can put into this and say, okay, if you diversify your result, I mean, your earnings on a risk-adjusted basis do increase. In fact, a more recent paper in 2021 by Lee indicates that diversification is beneficial, and these authors consider US data. And particularly interesting is that most of the studies prior to actually this paper in 2021 seemed to indicate that diversification is not beneficial, particularly in the US. But then, so these authors have to justify why they find a different result, and they seem to agree that plausibly COVID-19 pandemic was a bit unique, and some factors associated to this pandemic might have turned the relationship, so that now those banks that had a well-diversified portfolio experienced higher and stable returns even during the pandemic. Outside the US, there are a number of studies which indicate that diversification is actually positive. So we wanted to also find out from context here in Kenya, does diversification result in higher and stable earnings, particularly in a crisis? The second aspect that this paper was interested in is what was the evolution of loan loss provisioning during the pandemic? I know this has been mentioned earlier. I think one of the speakers said there were some adjustments that were made. And so kind of, again, here we are cautious because we just have 1 year data point. So as you will see later, we resort to a more exploratory approach than a more traditional regression type analysis. So how do we measure diversification? Now, there are two ways, and particularly in the literature, there are two ways you can capture diversification. One is, let me start with the easier one, is the proportion of non-interest income as a proportion of total income. That gives us a sense of diversification. So, but we complement this with another measure of diversification, which follows the Herfindahl type framework. So what we do is we break down, of course, the net, the total or the net operating income into net interest and net non-interest income. And then in step 2, we use equation 1 there to define a measure of diversification. And that measure, of course, if you look at it carefully, it will range between 0 and 0.5, where 0 means total concentration. In other words, there's no diversification at all, and 0.5 if there is a total diversification. So using these two measures, we then estimate, okay, before I say how we estimate the link between diversification and earnings, we know the earnings, particularly profitability, can be captured by return on assets or return on equity, but of course we adjust it for risk. And so we generate two measures, which are represented in equation 3 and 4. And so they represent the risk-adjusted measures. And for those who have an orientation in finance, those you will identify those as Sharpe ratios. Now, So the empirical model to link the two is represented in that equation 6. It's a simple panel model, and we put the two measures there because they implicitly they have different orientation. Diversification simply means you've diversified, but the share of non-interest income simply means that you have a bias towards non-interest income. And so we put them together. We check they are not really highly correlated. They're not correlated highly. And so we can put them in the same regression. And of course, X is a set of control variables. And then we control for time effects and fixed effects in the usual way. Now, in terms of, I just want to highlight the methodologies, then I'll go to the results. In terms of loan loss provisioning, we, as I said, I'm not really going to a regression type. Instead, I just I do a small exploration, a cluster analysis, just trying to see whether there were structural differences in terms of provisioning. Because we know provisioning, as I think one speaker said here, are highly controlled. These are they're prudential guidelines. But we just were interested in a simple and supervised machine learning, which is actually, in simple terms, a cluster analysis to check out, and we will see the results of this. In most of our analysis, we use 30 sample commercial banks, and that's a good sample. The period we cover is from 2001 to 2020 on an annual basis. But for diversification, we use data from 2011 because certain measures that we are interested in, we couldn't easily extract them from the earlier period from the data that we had. So in a snapshot, we also wanted to, I don't know if it's visible. That's just, we were, of course, interested to set the context by looking at the state of banking in Kenya over the year 2001 to 2020. So in terms of asset composition, we just note one interesting observation that over time, particularly 2015 upwards, there has been an orientation towards government securities, and more so in 2020. And so, of course, we do not really interrogate this further, but the question we were asking is, could this be flight to quality, especially during the crisis? In terms of capital ratios, the capital ratios seem fairly strong, even entering to the pandemic period. Actually, they remain steady. Although Tier 1 leverage ratio seems to have taken a marginal decline, but really nothing to worry about the capital strength according to the sample data that we had. In terms of credit risk, NPLs actually dropped slightly in 2020. But of course, provisions in terms of aggregate provisions went up, and a sharp increase. There seems to have been aggressive provisioning in 2020. We'll mention something towards the end. Profitability has been declining over some time now, according to the data that we had, and also even in 2020 there was a decline in average profitability of the banking industry. In terms of trends in diversification, the interest income remained resilient even in 2020. Actually, there was an increase. If you look at 2020, the last two bars, the blue one is, I don't know if that is blue, I have challenges with colors, but the last one is the tall bar, the second last, that's for interest income, and you can see it actually increased in 2020. Although there was a slight decrease in non-interest income, maybe probably the muted economic activity would have resulted in a drop in non-interest income. We also decomposed the components of non-interest income, and we also noted that, of course, the main source of non-interest income is fees and commissions, which also dropped, again, probably because of the muted activity. But there was a slight increase in other income, non-interest income sources, I think, such as foreign exchange. So the first thing we do in terms of empirical analysis, we wanted to see if there was any particular benefit, particularly in 2020. So this is more of a cross-section. So it's just a snapshot. Of course, it has its weakness because banks have a strategic plan, I guess, and so it takes a while. But we just wanted to see, were banks that were well diversified in 2020 experience any better risk-adjusted profits than their counterparts? Again, this is a univariate analysis, doesn't control for many other factors, but that's the best we could do in terms of trying to have a glimpse on diversification effects. So what we do is we divide our the banks in 2020, the 29 or 30 banks, into groups based on their share of non-interest income. So the first, the one written bottom, those are the ones that are least diversified, and the top are those that have higher proportion of their income derived from non-interest sources. And for sure, we realize, although it's rather weak evidence because the T statistics aren't significant, the difference between the bottom and the top, but you can see there is you know, a monotonic increase in risk-adjusted profit as you move towards highly diversified banks. And so as a preliminary result, we can indeed say that banks that are well diversified, particularly banks that have an orientation towards non-interest income sources, tend to experience higher and stable earnings. That looks very tiny, but of course, I know. So the main observation from that panel regression. So what we do is we extend the period so that at least we can understand this relationship, not only in 2020, but look at the pre-pandemic period. And we find a strong relationship between the non-interest share and earnings, which kind of ratifies what we had seen in that univariate analysis, that indeed diversification do have positive benefits in terms of earnings. In terms of provisions, our empirical results, we start with some descriptives. So we just were interested to understand the evolution of some of these credit risk measures. So if we look at the first column on loans, that's just growth. And in 2020, yes, there was growth in loans, but it was a bit, it was at about 8.9% as opposed to 2019 when it was 11.7%. Loan loss provisions in 2019, loan loss provisions increased. The growth was 11%, but it was 44% in 2020. So there seems to have been quite an aggressive provisioning in 2020. NPLs, apparently, actually there was a marginal decline from 14.7 to 0.24. It's not really considerable, but there was a slight drop. We are interested in this measure of provision, the ratio of provisions to loans, and usually this is also referred to in the literature as cost of credit risk. And in fact, in the subsequent analysis, we focus on this measure as, you know, what happened to the cost of risk. So the idea here is, for instance, in 2020, it seems that for every 100 shillings you give us a loan, it costs you about 8 shillings to, I mean, it costs in terms of the risk that that loan brings to your loan book. So there was a marginal increase in cost of credit risk, although not really very notable. NPL coverage ratio also improved, probably because NPL coverage ratio here is obtained as provision to NPL. Registered as a slight increase from 67% to 68%. So we also try to understand the structural differentiation in terms of cost of risk. So as I promised earlier, we follow up so the entire discussion on cost of risk. So we were interested, were there significant, I mean, were there differences in loan loss, in cost of risk across the banks? Were there banks that were homogeneous? Were there banks that were similar in terms of their cost of risk? So we do a cluster analysis, and we identify, we managed to isolate about 5 groups of, so we are able to group about the 30 banks into 5 groups according to the level of their cost of risk. And interestingly, we find one particular cluster that has just one bank. The good thing is here, these are just numbers, so it's only me who know the bank. But generally, it appears as an outlier in terms of cost of risk. In fact, that particular bank is cluster 4. It had a very high cost of risk, although actually even in 2020, if you compare across banks, it had a very high cost of risk. It was actually a drop for that bank. So which means 2020 might not be that bad as maybe probably we would have imagined. But we go back for each cluster. We try to go back and to our raw data and check, even before the pandemic, what was the evolution, what were the dynamics in terms of cost of risk. So for instance, this bank, it had 12% in 2017, 18%, 28%, 26%. In fact, if you scan through the clusters, you can see cluster 1 had an average of about 7.7. And this were a cluster that had fairly large banks because the average total assets is about 202 here, billion. I hope I'm right in terms of the. Then the following cluster had an average of about 5.3, although it was not really from very large banks, but maybe fairly medium bank. The third cluster, which also I was interested in this third cluster, of course, the average was 7.5, but actually in 2020, they experienced a very low, the lowest actually among the clusters, the lowest cost of risk. And these were very small banks, an average of 38 billion in terms of assets. I just want to go back to this bank, I mean, this cluster 4. I also noted that they also experienced really NPLs that have been going up and among the highest I could find in the data. and declining profits. So probably besides the cost of risk challenges, it seems like there are some few other challenges. Now, what these clusters really help us to do, and which we encourage probably is that you are able to, we are used to the tired peer, group analysis, but I thought this can complement. It's kind of an alternative to provide more insights about the structural differences in banks, not only during the crisis, but generally. This could be useful in terms of, the supervisory off-site surveillance, and probably. So it just gave us a glimpse, and probably more can be done to understand the structural differentiation of these banks. So in conclusion, our univariate analysis uncovers that a shift to non-interest income results in higher and stable bank returns. In terms of loan loss provisioning, we observe that the COVID-19 pandemic seems to have prompted banks to increase their provisions in 2020. The cost of credit risk seems to have increased marginally, but the increase is really small to really worry. NPL dropped marginally in 2020. And so we were trying to, crack our heads. So if NPL did not really increase substantially, then what prompted the aggressive provisioning? But then probably we thought, okay, it was kind of provisioning was based on a forward-looking, maybe based on macro forecasts. This informed the provisioning because of the uncertainty that involves around the pandemic. Probably banks were cautious to, and so the provisions really went up. So from our analysis also, we find structural differences. We are able to isolate banks with similar behavior of cost of credit risk, especially during the pandemic, because actually the clustering was done just for the year 2020, and then we used that to look back and see some other, understand the history of these different clusters. So in terms of policy implications, the positive diversification benefits implies that banks can be encouraged to leverage on new technologies to create non-traditional products, but also calls for regulators to remain open to such innovations. The aggressive provisioning, again, because there is an interplay here, there was uncertainty that caused by the pandemic, but there is also the IFRS 9, which I know provides some guidelines on provisioning, which is more forward-looking, and probably in my conjecture, I would, think this could have played a part in provisioning. I know there are guidelines, but these guidelines are based on what is your projection about the what you think about the loans. You have to assess the loans that are going to be non-performing and then provide. So that, of course, involves a bit of judgment, a bit of modeling, and so on. And of course, finally, the clustered analysis, it's our recommendation that can be incorporated or can be used to complement the often tired peer group. So instead of just saying, let's group these banks according to their size, you can use this cluster analysis to group them in, into homogeneous groups, not necessarily because these are large banks. They could be similar in their behavior, not because they are big, but because they have certain aspects that move together. Thank you so much.
Thank you, Rogers, for very clear presentation on loan loss provisioning, diversification from varied perspectives, especially during period of COVID, of course, bringing out some of the interesting developments that were evident through the data. Of course, there may be other developments that are not necessarily captured in the data, but then it would be interesting to get feedback from our participants on the same, and particularly those from the banking fraternity. So for this paper, I think I did mention to you that the discussant is Dr. Caroline Kariuki from Strathmore University. So we allow her to do the discussion. Thank you. You're welcome.
Okay, so good afternoon, everyone. So I'll be discussing the paper by Rogers. Thank you, Rogers, for taking the time to write and work on this paper and for the good presentation, as Dr. Tiriongo mentioned. So as Roger mentioned, the paper that he was working on, or he's working on, is on bank income diversification and loan loss provisioning during the pandemic, but also takes the time to tell us what was happening before the pandemic and looking at evidence from Kenya. So I'll go through the paper, through the different sections. I'm aware of the time limit that I have, so I'll just give, an overview and look at ways as to what else could be done to improve on the paper, and of course to appreciate even the positive aspects of what have come up. So just in summary, or to build up or to summarize what Rogers presented. So there was a highlight of how, let's say, especially given reports from the central bank and even other organizations, there've been situations like, for example, in the banking sector, where we've been seeing perhaps a decrease in profitability or increasing maybe operational costs due to some aspects such as loan restructuring, increased expenditures in maybe some of the banks, especially during now taking measures in dealing with the pandemic, increasing NPLs, in some instances, maybe even decreased loans. So this was the setting that Rogers used to then indicate that, okay, given this now, then let us take the time to understand, do banks, for example, the first objectives, do banks that have a diversified income, that is banks that have expanded non-interest income activities, have they experienced relatively higher and stable earnings during the pandemic? And even what about before the pandemic? How were these banks, how are they doing in terms of their earnings, given if they have diversified income? And so to use this, to study this objective, Then Rogers used bank level data using 29 commercial banks. And for that analysis, I saw the data was from 2011 to 2020 using panel regression techniques and also a univariate analysis, as he mentioned. And then another objective of this research was to look at have banks used loan loss provisions to perhaps manage their earnings or capital given the uncertainty brought on by the COVID-19 pandemic. And so from his presentation, then he went on to using machine learning techniques, so specifically clustering analysis, to identify or to describe what's been happening in terms of loan loss provisions in the banking sector. And then the findings of this paper were that, in general, banks that have diversified into non-interest income seem to have been experiencing higher and less volatile profits, both before and even during the pandemic. And then in terms of loan loss provisions, I would say, of course, he also summarized it well, but there was also the aspect of the provisions increasing from, to about 44% from 2019, and perhaps some food for thought for us here to see why might that have been, the case and what could be done about that. So I found the paper easy to follow. There was definitely good aspects in there that I learned a lot from reading the paper. I would say in the background, Rogers can take the time to update some of the sections, some of the statistics, especially related to Kenya, maybe using the KNBS economic survey that came out not too long ago. And also take the time to also discuss about the banking sector. Perhaps some things have been improving in the banking sector. It's not all maybe dismal, maybe improvements in terms of maybe slight improvements in profits or in terms of the gross loans and perhaps the situation in 2021. So some of the that information can be added there, and also to give some insight, given the paper, of course, touches on loan loss provisions, more insight into the IFRS 9 standard and linking it to the Kenyan context. There was a discussion in the literature review that could move to the background. Also, as you were discussing, it was nice, you told us what are some sources of non-interest income in the Kenyan banking sector. It would be nice to also read more about that in the paper. I think that will really enhance it and give us a feel of what's happening in Kenya, what are the main sources for the banking sector. And also, it's interesting that, of course, some literature says that perhaps with diversification, there might not be any increase, or there might be a decrease, and perhaps it doesn't really help in bank earnings. And some of them say that, okay, diversification might increase volatility of bank earnings. And I found that section well explained, where some people or some schools of thought might go into the area of saying that expanding into non-interest income activities might require additional fixed labor inputs. But I thought, perhaps how does technology fit into this? Even as one is expanding into non-interest income activities, perhaps technology might help us in terms of reducing some of these inputs or some of these additional costs. And so I thought that was something that also could have come in even in the analysis. And also some information on how bank earnings are captured, like how you discussed on the ROA, ROE, that can be expounded upon. I would say the main aspect in maybe to summarize for the background would just be just to take the time to explain about the situation in Kenya, what has been done, because really at the end of the day, this is a research and someone would want to know what has been done in relation to diversification and earnings, what has been done in relation to loan loss provisioning. And then now we can see nicely how your study fits in and why it's important to carry out this research. In terms of the literature, so the studies provided were good. I found some other studies I could share with you, but also just to encourage you to include more studies that, of course, that are linked to Africa and also specifically also to Kenya, just to help to build the case and to offer a better background on the relationship between the income diversification and bank performance, as well as loan loss provisions. And I think also I wrote this in mind, perhaps with, because before you had also a regression where you were touching on perhaps are there some macro factors that would have an effect on loan loss provisions, but now you've gone to specifically into clustering, but nonetheless, it would be nice to see, are there studies that have incorporated like machine learning or such techniques into looking at loan loss provisions? For the methodology, I would say that was also, I followed it quite well. It would be nice to know or to have some characteristics of the banks used in this study, maybe the size of the banks, the ownership structure, or etc. Something else, just to give some more insight without revealing who, which banks they are specifically. And also, maybe I can also share this with you later, but even if you did some diagnostic tests, it would be nice to see that. You also did some correlation, but there was no discussion on that. So that can help to enhance your paper. Maybe I would say for the main thing or something I wanted to highlight for the methodology, as you consider maybe other factors that have an effect on bank performance, if you could consider maybe capturing the effect of technology or digital operations. I think from morning until now, there's been a discussion of what can we do as banks, maybe in terms of capturing technology or using digital operations, how that can link to perhaps bank performance. So it would be interesting if such an aspect was captured, even given in your literature, you mentioned that some study attribute the results between diversification and bank performance to fintech. And so that could be something that could be captured as well. And in that relationship of revenue diversification, there was a finding that the index has a negative relationship with profitability. So that diversification index, I imagine as you're going towards more diversification, there's a negative relationship with profitability. However, when the share of non-interest income is increasing, bank profitability is increasing. So I found the two to contradict each other. I'm not too sure maybe why that is. Maybe you could look into that. It would make more sense perhaps if the diversification index was perhaps meaning 0 being a higher degree of diversification. And maybe perhaps as you become less diversified, then maybe your profitability becomes less. So perhaps you could look into that and see why those two results seem to contradict each other. And then for the loan loss provisions, I would say the way you presented it was nice, and it's commendable to use machine learning techniques. I think a lot of the times we've been used to the normal regression analysis, but it looks as though to me there's so much more you can tell us from the clustering method and what you did, more about maybe even the clusters themselves. When you were discussing, it was so nice how you said cluster 3 maybe had maybe small banks, majority of the time, or cluster 4 had these characteristics. I think it really makes the point hit home, and the reader and the banks can understand more, given what the cluster reveals, and perhaps given something about the bank characteristics. And I think some things about the time period, just for clarification, maybe is the analysis for the cluster analysis from 2017 to 2020, or is it 2002 to 2020? I was a bit confused by that. And finally, really, I'll just end by saying that, thanks for the research. It was, interesting to read. And when you were saying that there's this relationship that as banks have more non-interest income sources, they tend to perhaps have higher earnings. Would this result hold for all banks, irrespective of size, irrespective of the source of non-interest income, ownership structure? That might be something you might want to expound on. And also, in terms of the cluster characteristics, I noted that operational efficiency seemed to be declining or staying the same for all clusters. And I was just wondering whether perhaps digital operations would help in this, and if there was a way, maybe this could also come out more in your research. Yeah, so thank you. Thanks a lot, Rogers. And those are my comments. Thanks.
Thank you, Caroline, for very insightful comments. I'm sure Rogers has picked them for improving and enhancing the paper. Maybe just before I open it up for any comments from the plenary, I would like just to make a few comments. Some of them have been addressed by the discussant. And I just took a step back to appreciate the concept of diversification. And I was asking myself, what are the options for diversification that can actually be availed? One is, of course, what the authors delved into, which is about interest income, non-interest income sources. Then I was also thinking about product diversification, thought about ownership structure diversification, broadening strategy to reach out to new segments of the economy, diversification along the asset classes and liability by a bank are options that could actually have been taken. So the question then would have been is why focus on the interest, non-interest income sources, and even within the interest, non-interest income classes, the extent of diversification within is also of greater interest. Of course, now that there is a narrowing towards one choice of diversification, there is need therefore to really split the issues within and discuss disaggregated assets within each of those, either the interest income or the non-interest income categories. So the other aspect that I was thinking about, so the idea is basically, can we ground the justification for the choice of the scope within which you have discussed diversification? The next item is about, I also took a step back to discuss the issue of the impact of COVID. COVID was unique in its own way in terms of it affected almost all sectors at the same time. So traditionally, the first thought that would come to somebody's mind is, in an environment of COVID, were there any benefits of diversification? And what would be the counterfactual? Like in the absence of COVID, would we see a different, or perhaps if the shock was different from COVID, would we see a different result with regard to this aspect of loan loss provisioning and diversification? Because one thing that came out with COVID is that while it happened broadly at economies level, meaning traditionally we used to know that when there is a shock, even in a global economy, some segments of economies would provide some rebalancing because they're shielded from the shock. But COVID came and it affected everybody. In any case, the traditional sources of rebalancing were hit more than the other sources. So even for the case of a country, each sector seemed to have faced COVID in one way or another. Each asset class products were affected differently and moved in different directions. And investments and enterprises adopted different technologies and different approaches and strategies to try and mitigate the impact of COVID. Some of them may have narrowed from a broader base of diversification to now narrow on their primary sources of income, just to strengthen so that there's a base for post-COVID survival. So all this is within the context of the nature of the shock that affected the economy and most of businesses at the same time, of course, not leaving out any banks. There are also issues about mitigation strategies, the containment measures associated with COVID. For instance, because of the social distancing issues, banks now were not doing the over-the-counter. I mean, to a large extent, over-the-counter transactions were now shifted to the digital platforms. So there was a thrust towards digital platforms, which of course had implications on both the charges that those different services now were attracting at any given time. So within the interest and non-interest income classes, and I think it was a question asked by the discussant is, what are these non-interest classes? Are they fees? Are they all sorts of other charges that are not necessarily defined under the interest rate? So how did some of them actually evolve during the period of COVID? Because we are discussing all this in the context of COVID. So it's of interest that we paint comprehensively the picture of what happened during COVID. How did it affect the traditional views about diversification? And of course, the loan loss provisioning also, as we did mention in the previous discussion, is that yes, we saw 44% growth in loan loss provisions, but during the same time, the central bank had actually suspended from the prudential guidelines the provisioning over 12 months, and yet banks went ahead to provision higher than what we saw even in the previous years. Of course, the requirement from IFRS 9. So it means bringing out the issues of IFRS 9 appeared to be the overriding goal to achieve, other than the prudential window, the window that had been provided through the prudential guidelines. So I think it's important to map out and bring out some of those dynamics that affected aspects central to the paper that was being discussed. So those are some of the comments just to add to what the discussant has said. And of course, at this point, of course, we would want to invite comments from participants here and even those dialing in online. You're free to send in your comments through the chat box. So there are 2-3 hands. I wanted to take all of them first, then we start with Samuel Kiemo. Maybe as you pick the mic, you introduce yourself and your institution of affiliation.
Thank you, Samuel. My name is Samuel Kiemo from Central Bank of Kenya. Let me take this chance to thank Rogers for a very wonderful paper. And I'll go straight to things that I like about his paper. First of all, it talks about diversification. And the other aspect is in terms of the trying to break down the different sources of income for banks. And the only thing which I would like to mention, which is good to appreciate, is that when we are discussing about loan loss provisioning, the banks may not have a great say on how much to provision and how much not to provision, because this one is guided by prudential guidelines. And it may not be so much as an action for the banks, because they have no choice but to follow the law, because the prudential guidelines already says how much you're supposed to do in terms of loan provisioning. So even on the results, the way interpreting the results, we have to be careful, because like when you said that in 2020 we saw that the provisionings were higher, automatically it was expected to have like that because already like Samuel alluded is that the central bank already had given guidance on the classifications of loans that in terms of restructuring. And of course, even though the central bank says that you cannot classify the loans, but for banks, they had to do provisioning because they don't know what will happen after the end of the restructuring period. So my suggestion is that if we can drop the aspect of loan note provisioning, and then we concentrate on bank income diversifications, we try to explore because those are things that the banks can do. Another thing is that for loan loss provisioning, it is usually a loss. When you increase the loan note provision, is a loss to the bank and it eats capital. So at the same time, the banks may not be so much interested in terms of doing provisions because one, they are reducing their profitability. At the same time, they are reducing their capital, and capital is scarce. So, but since the law is there to make sure that they follow that, I feel that even though the results are saying like this, it is as a result of a rule, not based on the action of a particular bank. But on average, on overall, the paper is good, and thanks for your time and energy of this paper. Thank you.
Thank you, Kiemo. Camila.
The author on the paper, I thought it was very well presented and discussed and explained. I particularly enjoyed or learned quite a bit on the cluster analysis and its use to isolate structural differences of the banks. I think that was an excellent use of machine learning, and it was a great learning point for me. I just have one comment or question. It didn't come out very clearly to me how diversification was related to loan loss provisionings and bank earnings. I don't know whether these were two separate objectives. I know that they came out as two separate objectives, but I didn't know if there was a link between all three of them, or why they were why these two objectives were included in the same paper.
Okay, maybe I can ask my questions or comments. Thank you very much, Rogers, for that paper. Just a few comments. One is on the diversification. Maybe you also need to explore, can we diversify through sectoral loans? Maybe a bank was investing more in agriculture, can it now move to ICT or another sector? This is what Dr. Tiriongo was talking about. Then two, I noted you used, I'm not sure if it's 30 or 29 banks. I'm not sure what happened to the others, because ideally they are around 41. And maybe that's why once you aggregate, there's a comment you made that the NPLs were going down in 2020, which ideally is not true. Because the first decline from January 2020 to, we are seeing the first decline of loans in June 2021. So maybe it's because of those banks we are missing in your consolidation. Maybe you need to consider and add them. Then at some point I asked myself, when you talk about the loan loss provisioning, we are talking about the total provisions or the gross provisions, meaning we have the general provisions and the specific. And if that's what you used, there's a ratio, which is NPL coverage ratio, which I think is not correct, because you used NPLs, you use provisions to NPL ratio. So the provisions here, I'm assuming is specific provisions which only relate to the NPLs, because you can't use including the general provisions. I think that's all. Just one more, it's on the clusters. Maybe it would be interesting to know how you clustered the banks into the 5 clusters. Like which factors did you consider to cluster them? Thank you.
Okay, thank you for those comments. Any other comment?
Okay, thank you. Also to add on what Irene has said on the clusters, I don't know whether you have factored in capital strengths in those clusters. because capital strength enables a bank to undertake higher risk, which in return gives you more revenue.
Okay. Okay. In the absence of many other comments, I don't know whether we have any comment from our online participants. Okay. So maybe at this point I can give Rogers about 1 or 2 minutes, then we can wrap up just to provide some feedback on some of the, you may not necessarily provide feedback on all of them, but basically on those that you feel are burning amongst those that gave comments. So Rogers.
Okay, thank you for the nice comments. About product diversification, yes, I agree. Here, I just focused on functional diversification, but I know there are several. I could have done a geographical, I could have. So I really appreciate, and probably that's something I can explore. And since the general feeling is that we can get to learn more on diversification, so probably I would try to see how that can be extended. Now, there was a question about the topic. Initially, it had a link, but after several, panel beating, I think something need the original thought. Yeah, there was a link because it was about loan loss provisioning, diversification, and earnings. So it was the sense that provision does have a relation to earnings, but somehow, and I think what we can appreciate is it's still a working paper. And one thing I appreciate is my interest is that we come here and have a debate, and then we can go back to our corners and try to understand what is really interesting. So for instance, there are things that maybe I cannot just sit in a dark corner and understand. So probably, for instance, in the loan loss provisioning, that's why I actually, I said, let me try something unorthodox, a clustering analysis. And now that it seems like it resonates well, now I can go back and do more work. Somebody asked how I clustered. For now, I just clustered on cost of risk. That's provision of a loan. So that's just one attribute, but it's possible to include more attributes if we are really interested. Of course, like if we are looking at credit risk, we can throw in NPL, we can throw in many other attributes and then cluster them. But because quickly we were thinking about the provisioning, so I just did again. I was testing the water, so now I can go back and I think that's what I can say for now. Some of the comments I will work on them as I relook into the paper. Thank you.
Okay, thank you for that feedback. That your comments are well taken. I know our time is far much spent, but I think we can afford 1 or 2 minutes for Gillian just to say something about some of the comments that came through.
I don't know. Oh, you can hear me? Yeah, good. Thank you, Dr. Tiriongo, for the chance. I mean, thanks to everyone who provided their comments and feedback. And I'd like to extend a very special thank you to Dr. Roslyn. I mean, the feedback that you've given me is really fantastic. Some things that I had not thought of at all. And just like Dr. Tiriongo said, I think you are the best person to review the paper. So thank you for taking that time to come through it, offer feedback and improvements. I guess what I can do over lunch, I can just approach Faith, Irene, and Camila to address some of the questions that they asked and even get their pointers on how I can incorporate some of the things that they mentioned. I think I particularly like the comment around, the comments around the measures that are being used in the paper, particularly the credit to GDP gap ratio, which it's a contentious ratio, I have to say. So it would be very good to get feedback on the same, on how you can incorporate that into the paper to make it better. Thank you.
Thank you. Thank you. I guess that's the essence of research and the essence of conferences, for interactions and enrich each other's views and perspectives. And of course, expanding our scope of thinking on various aspects. So thank you all for a very wonderful discussion. So this was day 2 of our conference. We still have one more day tomorrow, when we have also lined up quite interesting presentations, just as today's, for us to share and deliberate on. Of course, with the objective that at the end of it all this work would actually be presented as published as KBA working papers. At this point, of course, I would also want to draw your attention that since 2012, all the work that were actually presented in subsequent annual research conferences is actually available on our website, and you're free to engage on various aspects, some of them related in one way or another, some of the things we are discussing today here. And it would also be interesting to appreciate the journey through the discussions that we are having, because in the past we've had discussions about loan loss provisioning, we've had discussions about credit assessment, we've had discussions about virtually all the issues that we have discussed today. But it's interesting to see the thoughts at the time and the thoughts now, and even be able, based on that historical view of how things are moving, we can gauge where we are headed going forward. So at this point, I would just want to thank the authors who made this day possible. Of course, starting from our first 2 papers in the morning that was looking at the credit assessment in the absence of quality data, and of course, the methodological session shedding more light on alternative sources of information that can be tapped by not only banks, it could also be used by any business entity and any organization, really, because data is driving decision making, and therefore the need for us to explore how best to convert data to information. Then the next 2 presentations that we had this morning, of course, now this afternoon, is the COVID-19 policy interventions and the credit growth, of course, highlighting some of the occurrences at the policy space in terms of the mitigations against COVID-19, and of course, their impact on what is core to us, financial stability. Then diversification and loan loss provisions, again, very insightful thoughts around what we can do. But one thing that I must highlight in all this is that we've seen a lot of innovations, even amongst our researchers, that we are now opening up to use not necessarily the traditional metrics that we have known, but exploring options that could possibly be used. Of course, that's something commendable. And as we do this, it's of interest that as we domesticate some of the models that are availed out there, we look at them through the realities in the Kenyan context. And against this, we'll be able to generate results that are reflective of what's happening in Kenya. I also thank the discussants and those that commented on the papers, because all the comments that came through in one way or another will shape the papers to be better at the end of it all. So we look forward to the final works that will come out of the papers presented today, and more so the policy implications coming out of these papers would be something that we can carry forward, even engagements with other policy stakeholders. So with these few remarks, I think we have come to the end of our day 2 of the conference. And I also want to appreciate those who dialed in online and sent in their comments at the same time. You have engaged with us thoroughly too. So we encourage that let's finish strong tomorrow as we continue with 3 other papers that are lined up, basically looking at bank capital, credit risk, and financial stability in Kenya, macroeconomic shocks and credit risk in the Kenyan banking sector, and finally, COVID-19 and finance economic growth nexus. So again, very interesting papers. So I encourage all of us to make ourselves available for tomorrow's session. And of course, we continue with the fruitful and candid discussions that we have enjoyed today. So with these few remarks, I think I invite all of us for lunch. And of course, with lunch, it means we can pick our lunch vouchers with from Hillary. I think he's stationed somewhere next to our exit. And let me try some French. They say bona. I didn't want to say the second part because I feared the mother tongue interference with. All the best and have a fruitful and enjoyable afternoon. Thank you.